Happy Thursday. Happy Thursday. Happy Thursday. You guys are here for the options party. All right. We have one more webinar, and that's next week. So if you don't know about my webinars, I start the webinars off at the beginning of the month with the stock party. That's going to get you your fundamentals that you need to invest in the stock market. So if you missed it, that's okay. You can go to my PayHip. What is it? PayHip.com/Joel Harrison. You can see the old videos and you can get caught up for the strategy party next week, but it always starts out with the stock party because you got to get your fundamentals in place. All right, then it's followed by the futures party for those people that want to make, trading and investing a business, earning your salary daily so that you can invest in the options market or the stock market. And then we follow it up with the options party, which is the ultimate way of trading. And I'm going to show you guys how to do that today. And we follow it up at the end of the month by putting it all together. And I'm going to show you guys strategies next week and how to approach the market. Now, we're going to do a lot of it today, but we're going to do it towards the end of the session. And then I'm going to give you guys a treat at the end of the session. I always do a charts with Joel. If you are not a part of the Inside of Trading Room, I want you to join it. It's on Facebook. It's the room with the gold bars at the top. So we have over 7,000 members. They're traders there that are there to help you. Look, I screen every single post that comes through, right? So I want to make sure that everybody's getting educated. We don't have no flim flam type posts. Every now and then I'll let a person, put out a receipts post on how much they made. But for the most part, we want it to be informational. We want it to be educational. Me and Noble created that particular room over 10 years ago. So it's like an almanac, and I want you guys, it's one of the oldest trading rooms on Facebook. All right, so let's go ahead and get started. I see here that a lot of people are getting a lot more comfortable trading the market, all right? I used to get a lot of red, all right? So I'm surprised to see that everybody's comfortable buying stock, comfortable buying options. If you're comfortable buying stock, then options is going to be real easy for you. All right, so we're going to answer another question. How often do your trades win? And I got to figure out what's going on there. Hold on, let me pull up the, all right. Okay. All right, 67% of the time, 50%, 20% of the time, 25% of the time. Nobody's trades win 50 to 75 to 100% of the time. That's not good, all right? That's why you're here today. I teach people price action. So when you learn price action, no matter what you're trading, a lot of the tools and the strategies we're gonna use today, no matter what you're trading, I don't care if it's Forex, options, stocks, cryptocurrency, you're going to be able to trade the market. That's my job. I'm gonna do a little bit of chart reading. We're gonna get a little bit of everything today, all right? I'm gonna give you guys a gumbo of education. So I don't really want you guys to take notes. You guys are gonna have access to this video up until Monday. Yes, up until Monday. So you got Friday evening, Saturday, and Sunday to watch it a million times. And then I take the video down. And then if you want to purchase the video, you can do it on Monday. All right. The strategy party next week is going to show you guys a lot about how to approach the market. Okay. But 25% of the time, I'm going to show you a couple of strategies today. The John Carter being one of them, the 200-day moving average. And we're going to approach the market in 3 different ways. So I'm going to try to change your way of investing and trading. All right. So what charts do most of you use? All right. All right, and what I mean by chart is everybody has that favorite chart that they look at, the 1 month chart or the 1 day. If you don't know what we're talking about, that's fine. We're going to cover it today. What chart do you use mostly to trade? Okay, go ahead and answer that question for me. All right, we got people that uses the 1 minute chart. We got people using the 1 hour chart. Nobody's using the day chart. Interesting. The day chart is actually, there we go. The day chart is actually the most commonly used chart. So I want you guys to switch it up. You guys should be looking at a day chart. We're going to talk about the easiest way to make money versus the hardest way. So every single webinar, I try to make it better and better so that I can help the most people. All right, everybody's not going to be able to trade daily because they have 9 to 5 jobs. Everybody's not going to, some people can't wait 6 to 8 months to make money. They need to make money now. So you got to know what chart you're looking at to determine, in my opinion, how to trade or invest. That's kind of cool though. Everybody's using the 1 minute chart, which is interesting. Now, in my opinion, the 1 minute chart is the chart that you use when you're going to get in and out the same day. So I want to see, how long you guys typically stay in a trade. How long do you typically stay in a trade? Is it 1 day? Is it 2 days? Is it 1 week? Is it 2 months? Is it a year, 2 years? Now, see, this is interesting. You guys are just from the jump. I can see why a lot of people are only winning 25% of the time. All right. Most of you guys are in the market, for days. If you're in the market for days, there is no reason for you to be looking at a day chart. Okay. I understand day for day chart. Okay. Well, a lot of you guys are looking at the minute chart. I'm sorry about that. There's no reason for you to be trading for a couple of days looking at a minute chart. Guys, what happens in the next 15 minutes is not going to determine what's going to happen in the market for the next couple of days. A lot of people, a lot of my clients, when they come to me, that's one of the number one reasons why they're losing money. All right. We're going to break it down today in a 1 minute chart, a 1 hour, and a 1 day. And you're going to know how to approach the market and how long to be in that particular trade. So when do you exit a trade for profit? I always put these questions out there just to see if it's consistent. And sure enough, every webinar, it's consistent. All right. You get out when you set a target. Okay, stocks hit the target that you set, which is interesting because 80% of the time you exit the trade, but you're only winning 25% of the time. Okay. When you made enough money. Now that's interesting because making enough money is relative. It's subjective. What is enough money? All right. We're going to talk about risk to reward today. That's the number 2 reason why most traders lose money. Okay. They're risking too much money and not taking enough money when it's time to make profit. We're going to change that. We're going to go through it. Now, I see that only 6 people are answering. So this is interactive. I want you guys to tell the honest to God truth. All right. While you're doing this particular webinar. Okay. All right. So when do you sell a stock for a loss or sell your option for a loss? Go ahead and answer that question for me. You do it when you feel bad. Okay. A lot of people get out because of emotions. That's a very common response. All right. The maximum loss you calculated. Okay. We're going to learn about trend lines today. Some people say never. And those are for your long-term investors. See, most of us approach the market one way. We only have one gear. We only see the market in one way. I'm going to teach you guys how to look at the market in 3 different ways. You're going to look at the market from a short-term view, a medium-term view, and a long-term view. Now, it's different with options and stocks. When I talk about long-term with stock, I'm usually talking about 12 months or longer. When I'm talking about long-term with options, it's going to be 30 days or longer. Okay. I want you guys to start taking trades and options 30 days or more. You're going to win more. Okay. A lot of you guys are trying to be these stock stars. All right. And it takes a lot of effort and it takes a lot of discipline to be able to get in and out of a trade within 30 days and be consistently profitable. And a lot of you guys, that's where you're trading. You want to make that fast money, but you're not looking at charts, which is interesting to me. If you're not using charts and you're buying stock or options and you're selling them within a 30-day period or a 12-month period in stock, you are gambling. All right. So we're going to learn about that today. All right. So I'm waiting for, I think everybody's here. This is the options party. All right. All right. So here's the format of the options party. We are here to help each other. Now, I'm the host today, so I can't answer all of your questions. So I do have helpers. So if you have a question, and please make it a legitimate question. Don't just ask a question because I want you to ask them. All right. Ask a question if you truly need the answer. All right. All right. But I want you to ask a question in the text thread. And people, there's a couple of people on here that have taken options already. If you can answer that question for your fellow trader investor, go ahead and answer that question for us because it's a party. It's a family here. We're here to help each other. All right. So any questions that are out there, I want you guys to try to help each other, especially if you know the answer. All right, so I am a full-time day trader. This is what I do full-time. This is how I earn my income. I don't have any other hustles. All right, I'm an expert in stocks, options, futures, and cryptocurrency. And I teach that. I don't really go outside of my area of expertise like a lot of traders do. I know a lot of traders that'll read a book last week and then all of a sudden they're an expert this week. I'm not going to do that with you guys. I'm continually learning about the market and learning about different things in the market. But until I become an expert, I've traded it, I've made money, lost money, I've created a system, I'm not going to teach it. And that's what you get with me. All right, a very truthful trader that has real money that's invested in the market, that's in the trenches with you. Okay, and that's what you get with me. You can hear it through the passion of how I feel about stocks. You can hear it through the knowledge that I have about the stock market. So if you want me to be your coach, you do have that with me, a true trader that's in the market. I have over 10 years and over 10,000 hours of trading experience. So I want you guys to go out and get these 3 books. All right. Why? Just to have them. All right. I don't really recommend books that much, but I want you guys to get these books, especially this one, the Japanese Candlestick Charting Techniques, because I'm teaching you guys price action. See, people lie, but charts don't. Charts don't lie. Charts are the polygraph of the stock market. Okay. So that's why I use the technicals and I use the fundamentals. I'm a well-rounded trader. And not only am I a well-rounded trader and investor, I'm also buying short-term, medium-term, and long-term. So I can view the market from all different angles. I think by reading some of these books, you'll become more well-versed in the market. And then you too can be profitable over the years. Again, the Japanese Candlestick Charting Techniques book is going to be one of my favorites. It's going to have about 6 patterns that we look at in the market. So I want you to be able to look at a chart and say, oh, I see a head and shoulders pattern, or I see a bull flag, right? Or, oh man, we're trending sideways, but it looks bullish. You guys should be able to talk the talk if you're investing and trading in the market, okay? If you want to take this seriously, you guys got to learn it. And it doesn't take a rocket scientist to learn this. You guys can learn this stuff within 30 days and be really good at it. But you got to take it upon yourself to not only do what it takes to learn the fundamentals, but then also learn from the people that are actually out there trading and buying stocks and options. So we're going to talk about calls and puts today. We're not going to really go outside of calls and puts. There's a whole bunch of different options that you can take. They got condors and straddles and strangles. Now, I will talk about debit spreads, which are called verticals. And I'll get into it. I'm not going to have any slides because I'd rather you guys come to me personally so that we can learn it because it's a little bit more difficult to create a vertical spread. But I'm going to show you guys how to do it and why you should do it in the future. But we're going to stick to calls and puts. A call is betting on the market going up. A put is betting on the market going down. So again, I want you guys to answer a question for me. What brokerage do you guys use to trade? Now, I'm gonna be partial to TD Ameritrade because I've been with them for over 10 years. A lot of the strategies and a lot of the tools that I'm going to use today, you're not going to be able to find them on other platforms. You're only going to be able to find a lot of them on the TD Ameritrade platform. Now, TD Ameritrade is the biggest, baddest platform that's out there, in my opinion. Okay. And again, I didn't mention that before. Today, everything is, everything that we talk about today are the opinions of What Would Joe Do, my company, my business. All right. So I still want you guys to go out there and do your due diligence. Every now and then, I might be incorrect about something. So I want you to do your due diligence. Okay. This is new to me. I've been a trader my whole life. Everyone asked me to please educate the public on what I'm doing because what I'm doing is different from what other people are doing. So please don't kill me if I'm wrong. You know, I'm about 99% right. All right. And just call me out on it or hit me up in Messenger and say, hey, Joe, I think you were incorrect about something. You know, you might want to check that out. And then I'll say, oh, man, good looking out. And you'll get positive energy for that. All right. So 64% of the people are using TD Ameritrade. That is great. So I love the TD Ameritrade platform because not only do you have virtual accounts on the TD Ameritrade platform, but if you haven't gotten approved for options or futures, you can take their educational course that's free on their platform that they give to their clients. Now, mind you, TD Ameritrade and Thinkorswim are the same. TD Ameritrade is the company that you will open up your account with, and they're going to offer you the Thinkorswim platform. The Thinkorswim platform is the platform that the advanced traders use to trade. But you're not going to be able to just trade options or futures just because you open up an account. You got to get approved for it. TD Ameritrade is not going to approve you if they believe that you are new and you don't understand what you're doing because they are responsible for you. You're trading on their platform. They're responsible for you. So if you don't get approved for it, you can take their classes and that will give you a higher chance of getting approved on their account. Now we're going to talk about Robinhood also. Robinhood approves everybody. So if you don't get approved on TD Ameritrade, you can try at it with Robinhood. So why do people go to Robinhood versus TD Ameritrade? TD Ameritrade is just going to be a more advanced platform. There's going to be things I show you today where the Robinhood people are going to say, oh my God, I didn't even know that was available for options. All right, and that's why you're here today. All right, now, word is if you're using your phone a lot for Robinhood, you're not going to have access to a lot of the tools. So if you use the desktop version, you might be able to find a lot of the things that we talk about on the TD Ameritrade platform. I'm going to spend the majority of the time talking on the TD Ameritrade platform, but I know a lot of people that have both brokerages. They have a Robinhood account and they have a TD Ameritrade account. But the Robinhood account is a lot more user friendly. It's a lot prettier. Okay. So there are 4 steps to buying an option. Let's talk about that in the beginning. And a lot of you guys are not going to, this isn't going to make sense to you in the beginning. But you want to analyze your stock. You got to decide, if I'm going to take an option, why am I taking it? Is it because I want to be in it for a short amount of time or a long period of time? Then you got to pick a date. Options do have expiration dates. We're going to talk about that later. You want to pick a strike price. All right, we're going to talk about that, in depth as well. Okay. And then you want to calculate the break-even price. We call that your worst case scenario. Okay. Now I'm going to show you guys a video because again, I'm still waiting for some laggards to come. So I'm going to show you guys a live Robinhood video. Now, when you watch this video, it's not going to answer all the questions you have about options. It's going to answer maybe 30% of it. So it's still going to be a little foreign to you if you don't know anything about options, but it's going to give you an idea of how it looks. Okay. And then during the session, I'm going to explain to you exactly what you were looking at. So let's go ahead and look at the Robinhood video. Let me go ahead and connect my Bluetooth.
Now connected to Joel's MacBook Pro.
And this is on the Robinhood platform. Hello, traders. It's March the 16th. It's a bloody Monday. And the Dow and the S&P 500 are down over 7% this morning. So I wanted to show you guys how to buy options. All right, I'm going to take a quick trade. I think we might get a little pop in the next couple of days. And with options, I can get more bang for my buck. So I want to show you guys how to place a call option on one of the ETFs. So once you open up your Robinhood account, you definitely have to set up your options account. And once you set up your options account, you should be able to buy options on your computer, your desktop, or your phone. This is the desktop that we're looking at right now. So once you find the stock that you want to buy the option on, we're going to look at the Spiders ETF. And once you pull up the Spiders ETF, if you notice to your right, you can buy the Spiders in stock. As you can see, it will cost you $250 a share. But I'm going to try an option. All right. Now remember, when you're buying options, for every option that you buy, it's controlling 100 shares. So that's the beauty of buying options using the leverage. Okay. So if you notice, what I like to do is I usually like to go about, if I'm looking for a quick pop, I want to go about 5 days out. This is expiring March the 16th, which is today. So we don't want to take that option. We want to take an option that's a little bit further out. So we're going to go to maybe the 20th or maybe the week after that. So you click on the expiration date. We're going to go to the 20th, which is the end of the week. Because I'm only looking for, a 1 day or a 2 day pop. And once those options show up, we want to pick a strike price. So we see that the share price is $250. So I kind of like to buy at the money. So I'm going to choose the one that's the cheapest. All right. So we have a strike price here at $251 and $250. So I'm going to go ahead and go with this particular option here. Now remember, you're controlling 100 shares. So to get to understand how much this option would cost, it's 100 times this number. So just take a decimal point over 2 times. So this option would cost me $1,200. This would cost me $1,257. Now options do get a little bit pricey when there's a lot of volatility. So we're going to go over here and continue. We've already picked the option that we wanted. We want to buy one contract. So we're going to place one contract there. And we're going to do a limit price. So we see that it's $11.85. So we're just going to see if we can get it for $1,200 even. So we're going to put a $12 limit price. We hit review order. You see that I have $3,000 available, so we have more than enough money to buy it. So we're buying one option, which is controlling 100 shares at $12. As you can see, it already popped $36 while we were sitting here watching it. So we're going to review the order. Once we review the order and submit, you're paying $1,200 for the right to buy 100 shares. And as you can see, it's done. And all we have to do now is just wait and see if that option takes. All right. And that's how you place an option order. Remember, we were buying a call. We're only teaching you guys calls and puts. We're buying a call because we're betting on the market going up in price or this option going up in price, or we're betting on a put, which is betting on this price going down. And as you can see, just while we were watching it, the option went from 20 all the way down to $11.98. So I'm pretty sure that option took. So we're sitting in it right now at $1,200. Every time you see that move, that's $12 made, $22 made. I can sell this option right now and make $22. Okay, $25. All right. So that's how you buy an option. Thank you. I'm so polite. Thank you. All right, I'm going to show you guys how to sell a call option. And this is on the Robinhood platform. Traders, we bought a call option about 10 minutes ago, and I'm going to show you guys how to close that particular position. So as you can see here, we have the spider call that we just bought. All right, so you click on that option from your desktop. This is the desktop. You can buy it or sell it on your phone or your desktop. We're going to use the desktop. And if you notice, we're in the spider call. We used $1,200, and we're up, I think, $80 right now. We're up 6%. So if you want to get out of that option, you go to close position. We want to close one contract, and we want the limit price to be. If I want to get out right now, let's make the limit price like maybe $12.70. As soon as you review your order, we're closing our one contract position. Now we're at $12.50. So let's try to get out quickly. So let's just go to $12.30. We review the order, we submit, and bam, done. We just sold one contract for $1,230. In 10 minutes, I just made $30 buying an option contract. I didn't have to wait until the expiration date. This is the history. 8 minutes ago, I bought one call option. I used $1,200. I made $30 in about 8 minutes. And that's how you close a call option position using the Robinhood platform. All right, so there's always been a misconception that you have to wait until the expiration date. That is not true. You do not have to wait till the expiration date to get out of an option. An option works just like stock. If I buy a stock between 9:30 and 4 o'clock, I can sell it. Okay. All right. I can sell that particular option. I can get out of it anytime that I want to between 9:30 and 4 o'clock. You do not have to get out at the expiration date. Okay. And I know the expiration date is confusing a lot of you guys. We're going to talk about it now. But the reason why we're in the options market in the first place is because we want to make fast money. We want to use a little bit of money, and we want to make a lot of it, and we want to make it really quickly. All right. And that's why the options market is the ultimate trading tool. This is why Snapchat, the regular stock might be up 3% in one day. But in the options world, it's up 44%. So when Snapchat is up big, the options are going to be up even bigger. Why? Because you're controlling 100 shares per contract. Moderna is one of the coronavirus stocks. If it's having a big day and it's up 5 or 6% in one day, sometimes the options are up 100 or 77%. Imagine making a 100% return on your investment in 24 hours. Well, it happens every single day in the options market. And I'm not saying you're going to make 100% every day in Moderna. I'm just saying that a lot of the stocks that you talk about every day, you're going to see huge returns in the options market, which is why you don't have to trade penny stocks anymore. I don't want to see anybody talk about penny stocks in my insider trading room. All right. You need to be buying options. All right. Get educated and buy reputable companies where you can make these types of gains. Canopy growth. All right. You don't have to believe in the cannabis sector. You don't have to smoke it, but you can invest in it. All right. I invest a lot of money in the cannabis sector. I have stock and I have options in the cannabis space. Why? Because look, if it's up big, 4%, okay, my long-term accounts are doing well, but guess what my short-term accounts are doing? Doubling overnight. All right. If you're in if you're in particular options. And these aren't options nobody knew about. All right. Sometimes they're very easy options that you can pick every day. We call those your at the money strikes. Zoom might be up, we're on a Zoom call right now. All right. The stock might be up 5% in one day. The options might be up 300% in one day. Imagine making 3 times your money. You put up $100 to buy an options contract, and then the next day it's worth $400 or $500. That happens every single day in the options market if you play it the right way. Peloton. I just ordered a Peloton for my wife. The stock up 9%. The option can be up 200% in one day. All right. And it goes on and on and on. I hate the airline stocks. I hate them. Everybody knows that I do not like the cruise lines, oil companies, or airlines right now. But you know what? Get your money. If it's up 9% in one day, I would love to make a 600% return on Delta Airlines. Okay. Reputable company, ridiculous returns in one day. Okay. Silver. Why are we buying silver? Because anytime you hear that the federal government is printing money, I want you to run out and buy all the precious metals you can, preferably gold and silver. All right, silver because I can buy longer dated options. So in the options world, the cheaper the stock, the cheaper the option is going to be. So a lot of people can't afford gold options, so they'll go after silver. And silver is more industrious anyway. All right, and now we just heard today that rates are going to stay at 0 up until 2023. All right, and we might get another round of money being printed. Well, you're going to see silver and gold go through the roof. Silver is still not even at its all-time highs. That was a stock tip. All right, so why do you make those types of gains in the options market? Because you're controlling 100 shares. I'm going to say that over and over again. You're controlling 100 shares. All right, 100 shares. Maybe you didn't understand that. All right, maybe this is better. You're controlling a bundle of 100 shares. One option contract equals a bundle of 100 shares. Okay. Or maybe you understand it a little bit better if you understand it this way, where you're renting 100 shares of that stock. All right, and that's actually probably a better representation of what you're doing. Why are you able to make so much money? Because these stocks or these 100 shares that you're going to have control of, you don't own them but for a certain amount of time. So I like to compare it to like renting a car. All right, so if I went down to Miami and I wanted to rent a drop top Mustang for the Super Bowl, and that's what I actually did. I didn't want to buy a $50,000 convertible Mustang. I just wanted to rent it for 7 days. All right, so I put up $1,000. I don't know if that's how much it cost, but I paid $1,000 to rent it for 7 days, and that Mustang was mine for 7 days. Nobody knew that it wasn't mine. All right, nobody even knew that I lived in Florida, but I had access to that vehicle for 7 days, and as long as it was my vehicle, I capitalized on everything: the speed of it, the beauty of it, the drop top, the top being down, the wind blowing in my hair. All right, so you're renting shares and you're renting them for a certain amount of time. Now, the longer that you rent, the more expensive it's going to be. And I want y'all to think about that. If I take an options contract that's only 7 days out, it's going to be more expensive if it's 14 days out. And what are you doing? You're renting 100 shares. Let's say you look up at a stock and it's $100 a share. Well, if you're renting 100 of those shares, 100 times 100 is $10,000. That means you're going to control $10,000 worth of a stock, maybe for a little bit of money. Uh-oh, let's go back. Sorry about that. All right, so Tesla, for example. Tesla right now is roughly about $500 a share. I think it's like 420 right now, but I'm not going to change my webinar every other day. All right, so Tesla is $500 a share. So one option contract is going to control 100 shares. So that means I'm going to have access to $50,000 worth of Tesla, but I don't know how much it's going to cost me. Just like with any rental company, if I was renting a Mustang and I went to Budget, Alamo, and Enterprise, they're going to have a different price for me to rent that particular Mustang, even though it's the same vehicle at every single place, because every single place is going to have a different price. Well, that's how strike prices work. There's going to be a different price for you to control this many shares, and you got to figure out which strike you want. But every single strike, for every contract that you buy, you're going to be controlling 100 shares. Now, in theory, how can you figure out how much you can make? Because we're not going to even talk about how much it costs yet. We just want to know how much we can make. So in theory, think about it. If you control 100 shares of something, if it goes up $1, you make $100. I got 100 shares of it. Every single share, if it goes up $1, every share makes $1. So no matter what stock I look at, Google, Apple, Microsoft, Facebook, NEO, Pfizer, ArcBest, Freeport, ResMed, Eastman Kodak, it doesn't matter. A dollar move for every contract should make me $100 in theory. So if you look at Apple this week and you think Apple can go up $10 by the end of the week, well, a $10 move in Apple, and I'm controlling 100 shares, equals $1,000. So I can make about $1,000 this week on Apple if it moves $10 if I have one contract. Because no matter what stock you look at, a dollar move is going to yield you, in theory, about $100. Now, it's not going to be exact. I'm going to show you guys how to figure out exactly how much that's going to cost you. So let's look at this chart. A lot of you guys are newbies, which is interesting to me that you're trading stock and don't even know what a stock chart is, but I'm not going to beat you up because you're here today to learn. But a stock chart is going to always read from left to right. It's always going to read from left to right. You always put your stock ticker here. So if I type Apple here, and I'm using a 1 minute chart, because today we're only going to talk about 3 charts, a 1 minute chart, a 1 hour chart, and a 1 day chart. Well, what does this 1 minute mean? That means every single one of these candles represent a minute. If you look down here, this is 340, 341, 342, 343, 344. So in about 20 minutes, Apple rose in price from $381 to $383. If I had one contract of Apple, my contract would have been up about $100 in 20 minutes for every contract. Why? Because if you're going to make $100 for every dollar move and it moves $2, I'm going to be up $200 in profit in theory. I say in theory, guys, because it's not exact. It's going to be around that depending on what strike you pick. That's why you got to learn what strike to pick so you'll know exactly how much you make per dollar move. We'll talk about that later when we look at Delta. So in theory, I can make a $200. You mean to tell me, Joel, I can make $200 in 20 minutes buying Apple? And I'm like, yeah, we do it all the time. All right, I do it every morning. I don't do it every morning, but I take options trades that can yield me, hundreds of dollars in minutes. Okay, and I'm going to show you guys how to do that. Price is always going to be on the right side. So when you're looking at a stock chart, the first thing you got to do is know what chart you're looking at. All right, this is a 1 minute chart. If I'm looking at a 1 minute chart, chances are if you're trading like Joel using a what would Joel do method, you're probably getting in and out the same exact day. All right, if I'm looking at an hour chart, I can pretty much tell you if you're one of my students, if you're looking at an hour chart, you're probably getting in and out that trade within 30 days. If I see that you're looking at a 1 minute chart, I know that you're not going to be holding it overnight. A lot of you guys are doing it, which is probably why you're losing money. And then if I see you looking at a day chart, I automatically know that that trade must be 30 days or longer. No reason for you to look at a day chart unless it's going to be 30 days or more. I see some of you guys looking at a day chart, an hour chart, and a 1 minute chart to take a trade. So you're totally confused because you don't know what am I in today? Am I in tomorrow? Am I going to hold it for 20, 30 days? Like, what are you doing? So I want you guys to separate the time frames. So we're looking at candlesticks. Candlestick charts are going to be the most common chart that you look at. All right, the day chart is going to be the chart that people use the most. Why? Because most trader investors are really holding things for more than 30 days. Everybody now wants to be a stock star. Everybody wants to be a stock star, get in, get out, make your money really quickly, and they're not even using charts. And then you're wondering why you're losing money. Now, if you're trading that way, you are gambling. The stock market is a casino for you. But if you're using charts and you're looking at the time frames that you're supposed to look at, and you dissect that trade into either a scalp, which is getting in and out the same day, in and out in 1 to 30 days or 30 days or longer, it's going to make your trading so much easier because you can commit to the strategy. All right. And that's where a lot of you guys have issues with. You don't have no strategy. You just buy something and say, I hope it goes up in value. Off the news. Oh, I heard some news on Ford today, so I bought it. Why didn't I make money today, Joe? Right? And then blame the stock market for being a casino. That's gambling what you just did. All right. So candlesticks, let's get back on track. Candlesticks are going to kind of tell you what each of those candles you're looking at. It's going to tell you a story. So candlesticks are the most common chart that you're going to see people use. A bullish candlestick is going to be green. A bearish candlestick is going to be red. Now, if you're using the Thinkorswim platform, you're going to notice that they're hollow candles on my charts and solid. A solid candle just means that we opened at a certain price and closed at a lower price. If we were looking at a 1 minute chart, and this was 9:59, this was 9:59, and this was 10 o'clock. This would have said, at 9:59, we opened at $100, dropped to maybe 99, went up to 101, okay, closed at 100, okay. And then when it opened up over here, it opened up at 100, rose to 101, dropped to 90, and then closed at 95. So the body represents the opening and the closing price of that time frame. If we're looking at a minute chart, this is at 9:59. This is at the end of that minute. If we're looking at a day chart, this is 9:30. This is 4 o'clock. And then when the next candle forms, this will be 9:30. And then this will be 4 o'clock. The wick just tells you how high and how low it went during that particular time. So going long and short. So if you're in the stock market, you got to start using the lingo. The lingo in the stock market is, hey, you're going to hear people say all the time, hey, are you going long or are you going short? Are you bullish on the market or bearish on the market? So if you're trading stock or if you're trading futures contracts, going long means you're betting on the market going up. It's the traditional way of betting on the market. Going short is betting on the market going down in value. Some people, light bulb just went off for you. You had no idea you can bet on the market going down. Well, yes, you can. Well, in the options world, going long, you want to buy calls. So when you buy calls, you are a bull that is expecting price to go up. If you are a bear, you can buy a put, or you're going to be short the market. You are a bear, you're expecting prices to go down in value. So if I wanted to buy a call option on Apple, expecting it to go up in price, I buy a call, it goes up in price $2. I'm probably up about $200 in 20 minutes. So that's a call option. I'm betting on the prices going up. Well, if I was buying a put, how can you make money on the market going down, Joel? That makes no sense. Yes, it does, because money and energy, they're similar. Once created, they're neither created nor destroyed. They just transfer from one entity to another. When one person loses, one person wins. Okay? Energy just doesn't go away. It's just transformed into something else. All right? It's never destroyed. All right? Money's the same way. So it's similar in those ways. So if you're betting on the market going down and you buy a put at 384 and it goes down to 380 and you were betting on it going down, how much money did it drop? $4. Well, if you bought one contract, Joel already said you can make $100 per contract. You're going to be up $400 betting on Apple going down. Where did that money come from? The person that was betting on it going up. That's where the money came from. Okay? When that person betting on it going up lost, it went into your bank account. So puts are just betting on the price going down in value. Now we're going to talk about calls and puts mostly. All right. Calls and puts are the most common and the easiest options to create. All right. And they're going to make you or yield you the most money. Now they're the highest risk. All right. And the break even, we'll talk about the break even. The break even is a little bit harder to reach. So you have a lot of people that buy what we call vertical spreads. Vertical spreads are basically just calls and puts that are cheaper. All right. If you see a Tesla option that's $10,000 and you're like, dang it, I want to trade Tesla, but I just don't have the funds. Well, you can buy a debit spread or a vertical, and maybe that option might only be $500. Okay. So people use vertical calls to try to buy or give themselves a little bit more time and an easier trade to work out. They'll buy verticals, which we call debit spreads. Very difficult to create on your own. The TD Ameritrade account creates it for you. I'll show you how that works in the future. So first things first, what's the first thing we got to do if we're buying an option? Well, what's the first thing we got to do if I'm going down to Miami and I'm renting a Mustang? I got to know how long I'm going to rent it. All right, I'm going to be in Miami for 7 days. I'm just going to get an expiration date for the following Friday. Okay. So the very first thing you do when you're thinking about an option is how long the heck do I want to be in this option? How long do I want to rent 100 shares? Because I don't own them all. I can only rent them for a certain amount of time. That's the beauty of the market. You can't have it forever because you don't have the capital for it. Well, I'm not going to say you don't have the capital for it. You don't wish to use the capital for it. You want to control a $50,000 vehicle, and I don't want to buy the Mustang. I just want to use it for 1 week. I don't want to own $30,000 worth of Apple. I just want to rent it for a week. Well, first of all, options usually expire on Fridays. So this is back in July. And as you can see, these are the expiration dates: July 10th, July 17th, July 24th. Once you pick an expiration date, then you can decide, hey, how much is that option going to cost me to rent it for that 7 days? So we already know, okay, we know how much you can make per move. We don't know how much it's going to cost you. And then we also don't know what the worst case scenario is going to be if we wait until the expiration date, because we already know that we can get in and out of that option anytime we want to. All right. And Joel also said that you don't even, if you pick a strike, and we're going to learn about that in a second, just because you pick a certain price, the stock don't even have to get to that strike for you to make money either. So I don't know where you guys are learning some of the information that you're getting about options, but hey, it doesn't have to get to the strike in order for you to profit. You guys saw me make money in what, a minute or 2 minutes on a couple of options, and they never really reached their strike price. You don't have to, it doesn't have to get there. But if you wait until the last day, then that strike price is important. Okay, and we'll talk about that in a second. Options expire on Fridays. Let's say we pick July the 10th. All right, let's say it's July the 3rd, and we want to rent it for 7 days. Cool. If once you pull up July 10th, you're going to see a whole bunch of options pop up. You're going to see a bunch of strikes come up, and that confuses people. So we're going to break it down. So the easiest strike to learn from in the beginning is the at the money strike. Very easy on the TD Ameritrade platform, because whatever the stock price is at the time, let's say we looked up here and we saw that Apple was $383. We already know what the at the money strike is going to be, right around $383. So when we go to 383, you also are going to know the at the money strike, because it's where the black and the purple meet on the TD Ameritrade platform. So I didn't even have to look. I can look here and say, oh, Apple is probably around $383 because that's where black and purple meet, because that's the at the money strike. The at the money strike is the strike price that is literally around the same price as the current stock. Okay. And we do that, and that's called your at the money strike. You're also going to hear something called in the money and out of the money. I'm going to break that down. In the money does not mean that you're going to make money. I wish they didn't even call it in the money strike. And in the money strike, so at the money is at the same price as the stock. We looked up here, Apple right now at 3 o'clock during the day is 383. So the at the money strike is going to be right around 383. If one of your buddies said, hey, I just bought a at the money strike for Apple, and you see that it's 383, you're going to say, well, there's two to choose from. Did you choose the 382 and a half strike or the 385 strike? Your buddy might say, oh, I picked the 385 strike. And then you're going to say, oh, you paid about $184, right? And he or she are going to say, yeah. How did you know that? Oh, because I just pulled it up and I see what the price is right now. You said you got in about 5 or 10 minutes ago. It really hasn't moved in price. All right. If your buddy said, hey, I'm going to go deep in the money, that means that they're going to buy a strike price that's less than the current stock price. They're going to go to 367 or 370. Now, if you notice something, the cost of an option, remember from the video, you figure out the cost of it by taking the decimal point over 2. So this option is $1,315. This is $1,008. This is $855, $645, $305, $105, $32, $16, $6. Okay. And I know you're saying to yourself, why would I pay $1,315 for an option when I can pay $6 for an option? Like, I mean, I'm not that smart, but I mean, anybody would rather pay $6 than $1,000. Well, there's a worst case scenario for that, because every single one of these options, whether you pay $6 or $1,000, guess what, people? Every dollar move, in theory, you're going to be up in value if the stock goes up. If you buy this option right now, and Apple moves from 383 to 384, most of these options are going to make $100 on that dollar move in the next 10 minutes. You got to decide, do I want to pay $1,000 or 16? And I'll show you the strategy behind it. Okay. So again, how do you figure out how much an option contract is going to be? Just multiply this times 100. We call that your premium. And you always buy the premium on the ask. I'm going to say that 3 times. You buy the premium on the ask, buy the premium on the ask, buy the premium on the ask. Please don't buy don't buy a premium on the bid. If you buy a premium on the bid, you have just made an ass of yourself. All right. Because when you buy on the bid, it's a totally different trade. That's called selling covered calls. You have to have 100 shares. That's where you guys hear horror stories about the options market. We're just talking about buying calls and puts today. So I'm going to tell you something that's going to make you so happy. Whatever this amount of money is, that is the most amount of money that you can lose if you're buying a call or a put. If I spend $1,315, that's it. That's the maximum amount of money that I can lose on this option. So even if I have $5,000 in my account, I don't have to worry about it eating into my other money. I'll just lose $1,315. I'll tell you guys how to lose it, how you can lose it later. Okay. But for now, you guys got to know this is at the money. This is deep in the money. In the money is lower than the actual price. So anything lower than 383 is in the money. Anything higher than 383 is out of the money. At the money, in the money, out of the money. At the money, in the money, out of the money. One more time. At the money, in the money, out of the money. Doesn't mean that just because you buy an option in the money doesn't mean that you're going to make money. It's just called in the money. And I'll show you guys why this scenario might be different from that one. And it's because of the break even. So I know I'm going back and forth because I want you to see it from Robinhood and TD Ameritrade, Robinhood and TD Ameritrade. So if you're on the Robinhood platform, let's say we're looking at silver right now, and silver right now is $2,083. What is that telling me? That means if I want to control 100 shares of silver, I can control $2,000, $2,083 worth of silver for $6. I can control $2,000 worth of silver for $6. And if silver goes up $1, I might make $100 in theory, and I only put up $6. So we call this thing your break even. So break even is your worst case scenario. Now we can talk about the expiration dates. See, you can make money up until the expiration date. It can go up, it can go down. The most you can lose is $6. The most you can lose here is 10, 16, 29, and 50. All right. The most that you can gain is unlimited. Because no matter how, if silver goes up in price, you get to capitalize on all the upside of silver, and you can limit your downside. That's why this is the ultimate trading tool. You capitalize on all the gains, and you limit your risk. It's the ultimate trading tool ever created, because this is the most amount of money that I'm going to lose on a call or a put. But there is a worst case scenario. How do people lose their money? The $1 million question. How the heck do I lose my money? Joe, you done talk about how to make money. I get it. $1 move, $100. You done said it 77 times. How do I lose my money? Well, The expiration date is how you lose your money. If you mess around and wait until the last day at 4 o'clock on Friday, July the 24th, and silver is not higher than the strike price plus the premium, then you're going to lose your premium. I'm going to say that again. Let's say I bought this strike for silver. It cost me $10. And let's say silver goes up $1. I might make $100 and I only put up 10. But how do I lose that $10? Well, I have up until the 24th to rent that stock. On that day, on this day at 4 o'clock p.m. on the 24th, if the actual silver price, if silver the stock, right now it's at $20.83. If it's not higher than $21.10 by this date, I lose my $10. Well, Joel, what happens if you're up $300 and then the next day it just drops and it's $21 instead of $21.10? Then you lose your profit and all. I mean, you lose your profit and your premium. Well, what if I was up 300 and I just sold it the day before? Do I get to keep it? Yes. Wait, hold up, Joel. You mean to tell me they created a tool where I can control $2,000 for 10? Let me get this right. I can control $2,000 worth of silver for $10, and that's all I can lose, 10. But if it goes up $20, I can make $2,000 and I only use $10. But I had until this day. I'm like, yeah. Well, then why isn't everybody doing it? I'm like, I don't know. This is why the rich get richer. But what you guys are doing is you're risking too much of your money or risking too much of your account, and that's why you see so many people losing in the options game. All right. So the break even. Let's go over the break even again. The break even basically says that if the stock is not higher than the strike plus the premium, you're going to lose your premium. If the stock price is not higher than the strike price plus the premium, then you're going to lose your premium. So that's the difference between this one and this one. Look at the break even here. They're going to pay a lower price. But look, they're paying a lower price because it's harder for silver to be up higher than $21.56. Watch this. You see how this is higher than this, and this is higher than this, and this is higher than this? These are your worst case scenarios. Silver has to be higher than these prices or you lose this money. So that's why this is cheaper, because it's a higher price. Okay. But this one is better than this one. Because look, its break even is $21.10. That's better than that one. So you got to pay for that. You got to pay for a better break even. See, the lower you go, look, $20. If we're at $20.83 right now, and all you have to do is silver has to be higher than $20 by this date, you have to pay for it. That's why there's different options prices. Okay. Break even. Break even is your strike price plus your premium is your worst case scenario. Okay. All right. I want you guys to understand that. Now, this is the TD Ameritrade platform. We're going to do the same exact thing. Apple right now is $308 a share. Okay. That means I'm going to control $30,000 worth of it for every contract that I buy. So I don't want you guys to get confused when you see this, because right now a lot of you guys' eyes glazed over. Well, first of all, are we going to buy a call or a put? So let's break this down. When you guys pull up your TD Ameritrade platform, you're going to type in Apple. And I'm going to show you guys this live. When you type in Apple, you're going to see an option chain. When the option chain pops up, it's going to ask you what expiration date you want. How long do you want to rent Apple? How long do you want to rent $30,000 worth of Apple, Mr. Harrison? Well, do I want to rent it for $410 for 7 days? Or do I want to rent it for $605 for 14 days? I don't want to spend $600 and something. I want to spend $400. Well, what's the worst case scenario here, Mr. Harrison? Well, let's see what Apple is right now. Apple right now is $308 a share. Well, at the money would be $307. That's why it says that. Why would a person go out of the money? Because they're going to pay a cheaper option. Out of the money means higher than the stock price. In the money means lower than the stock price. If I have a break even that's lower than this, I got to pay for that. That's why somebody is willing to pay $1,900 versus $90. This has a better chance of working out by the last day. Now, I know a lot of you guys already forgot what we said in the beginning. You don't even have to wait until the expiration. So you're never going to see Mr. Harrison, Mr. Joel buying in the money. I never buy in the money. Why am I going to spend all this money? I'm a technician. I'm buying this because I believe it's going up. So if I believe it's going up, I'm either buying an at the money strike or an out of the money strike. And when I go out of the money, I'm usually going with the one with the most volume. We're going to talk about that in a second. But these are your premiums. Out of the money is higher than the stock price. In the money means lower than the stock price. So what is this scenario saying, Joel? Well, let me find one that's easy. What is this scenario saying, Joel? It's saying if I buy this strike, Joel said the strike plus the premium is the worst case scenario. Strike plus the premium, strike plus the premium, strike plus the premium. 300 plus 10, 300 plus 10, 300 plus 10. That's $310. Well, what's the worst case scenario, Joel? If Apple's not higher than 300 plus 10 by, where's the date on this chart? Oh, by May the 22nd, I'm going to lose, where is it, 300? I'm going to lose my $1,060. Well, what if Apple goes up $3 right now? Let's say Apple goes up $3 in the next 3 minutes. Well, you're going to make $300. This 1060 is going to be worth $1360 because you just take the decimal point over 2. I spent $1,000. If Apple moves up $3 during the trading hour, I'm going to make $300, and I can get out. I can get out at 310.71. Now, Joel, did you make money only because it went higher than 310.60? Now, let's say Apple went up $2. I'm still going to be up $200, and Apple is only at 309.71. It never even got higher than $310.60, and I still profited $200. Oh, I get it now, Joel. You have the option of taking your money early or late, or you have the option of waiting until the end. And if I wait until the end, as long as Apple, the stock is higher than $310.60, I get to keep my premium, and anything that's over my strike price times 100, I get the profit. Yes, that's exactly it. You finally figured it out. Great, I'm gonna trade options tomorrow. All right. So how does it look when you're placing a limit order? When you're placing a limit order on options, limit orders means that price or better. So if I wanted to buy an option right here, I would pick the June 5th date. I would buy this strike. I don't know why I'm buying that strike. I'm just picking it. So if I pick this strike, it's going to tell me that the premium is $310. So 322 plus 3 is going to give me my worst case scenario. My worst case scenario is that if Apple is not higher than $325.60 by June the 5th, I'm going to have a maximum loss of $310. That's it. All right, I did say that's it plus commission. Sorry about that. I was incorrect. $310 plus your commission. My commissions are 65 cents per contract. If you buy 10 contracts, that's $6.50. You have to have enough money in your account to cover the option. So you can't just buy options just because. You got to have at least $310 in your account to buy options. If you got 309, I'm sorry, you can't buy options. If you have 310, you can't buy it because you can't cover the commissions. Okay, so you have to have enough money to cover the option plus the commissions. All right, so Greeks, how do we figure out how much you actually make per dollar move? And remember, I'm going to show you guys how this looks. I'm going to show you how this looks later. Okay, so we're going to look at the Greeks. The Greeks, there's 4 different Greeks that people use. They use the delta, the gamma, the gamma, and the vega. All right, now I'm only going to talk about delta today. I'm not going to talk about the other 3, but I'm going to send you guys a 30-minute video where this other educator is going to explain the other Greeks. I don't personally teach them because I don't personally, to be honest with you guys, I know about them. I just don't use them. I told you I'm going to be totally honest with you. I'm only going to use the things that I use on a daily basis. Well, the delta is going to tell you how much an option price actually makes per dollar move. I know I've been saying in theory, but every single option is not going to make the same amount of money per dollar move. Delta is going to tell you that day how much that option will move. So for example, let's say I was looking at Apple. Let's say someone bought an option here for $1,535 and they're day trading, meaning they know that they're going to get in and out the same day. They don't even care about the strike. They just want to buy it. If it goes up, they want to sell it for a profit and get out. Well, when you pull up the options chain for Apple, you're going to see something that says filter mines off. Spread is going to tell you what type of option you're looking at. I want you guys to pick singles. You're going to buy single options, single calls, single puts. Calls are going to be on the left side. Puts are going to be on the right side. Calls are going to be on the left side. Puts are going to be on the right. So when we were looking at this particular option, when we were looking at this chart, a lot of you guys were getting confused because you were looking over here. I want you to cut this in half and decide, oh, am I buying a call or am I buying a put? If I'm buying a call, I only need to look at this side of the chart. If I'm going with this expiration date instead of this one, then all I have to do is look at this part of the chart. Then all it comes down to is picking a strike. Do I want to buy an at the money strike, an in the money strike that Joel never buys, or an out of the money strike? Okay. And then I got to figure out what's my worst case scenario and the amount of time that I want to be in it. But then if I'm day trading it, I got to figure out how much I'm going to make per day. Well, over here, you take the decimal point over 2 also to figure out how much you make per dollar move. So I'm not even going to look at these strikes over here. I'm just going to say this one right here, for every dollar move, I'm going to make $27. I don't know how much it costs, but this one is 27. This is $43 per dollar move. When I say per dollar move, I'm literally talking about the underlying. The underlying is the main stock. So if Apple, in the next 30 minutes, let's say you bought an option. I don't even know what strike you picked. I don't know what strike you picked. But let's say Apple moves $3. If it moves $3, that means this option right here is going to be worth $18.35. This option is going to be worth $17.40. This option is going to be worth $14.50. Why? Because every dollar move, I'm going to make $100. Now, I can't really calculate that in my head, so let's go down here. All right, this option is going to be $63. Why is it going to be $63 that I made? Because for every dollar move, I'm going to make $21. 21 times 3 is 63. How much money did I spend to make $63 if Apple literally in the next 30 minutes goes from 343 to 346? I'm going to make $62 here, and I only used $143. That means I almost made a 50% return buying this option. This option moved $62. This option moved $42, and I only used $90. So where these options, I almost made a 50% return. Check this one out. If I made a $300 move, a $3 move making me $300, where this option is now worth $1,800, I only made about a 20% return. Now, a lot of you guys are still confused. Look, this is how much money I spent on the option. This is how much it cost me to rinse. It's not going to get, it's debited, but it's not going to get debited out of your account. You're still going to see $15.35 in your account. And then if it goes up in value, you're going to see this option go up in value. It's going to go up $100 per dollar move. So if this moves $3, I'm going to make $300 on top of my $1,500. So this option is going to be worth $18.35. Well, that means I would have made about a 20% return, which is why I don't go in the money. Because even though this gave me $100 per dollar move, my return on investment is higher when I go out of the money. See, I made $42 using 90. That means if I had spent the same $1,500 and bought about 15 contracts down here, I would have made about $700 here, where I would have made $300 there. Okay, so you can use the Greeks for day-to-day movement. Check it every day, because every single day you get closer to the expiration date, this delta is going to change. I also look at volume. Trading volume is the number of shares or contracts traded in a given period. All right. Looking at volume is kind of like what I call legal insider trading. Imagine being able to watch what the billionaires are buying. See, in the stock market, I can't really see it. I see volume going into Apple, but I don't really know how many. I see a bunch of volume and a bunch of shares being bought, but I don't necessarily see how many people are shorting Apple as well. I can see volume, but I can't tell if it's good or bad. Well, in the options world, I can see if the volume is good or bad. I call that legal insider trading. So watch this. You can also look at open interest. Open interest goes along with volume. I use both of them. Either if the open interest is crazy or the volume is crazy, then I like to pick those strike prices. So let's say I was day trading and I wanted to buy an at the money strike. And I was looking at the calls, and I see all this volume over here. 20,000 contracts being bought, 19, 12, 10. And that means that's how many contracts are being bought because of the volume. And then I look at the puts, and I don't really see any volume over here. What is that telling me? It's telling me that more people are heavily buying calls, betting on the market go up. And the more people that bet on one side, the more likely that the market's going to pull to that side. Okay, so you can use options to kind of see if it's overweighted calls versus puts. I also like to look at strikes. You see how only 99 contracts were bought at this strike price, but 20,000 were bought at this strike price? Well, do you trust 20,000 people buying or 99? I would trust the 20,000. So I would buy that strike price for whatever time frame that I'm looking at. Let's say I'm buying 6 months out. I usually will go out of the money and I would buy the one with the most volume, because it's probably the one that somebody got some illegal information and knew something about that stock. And I'm going to match it, or I'm going to see what people are buying. And there's all kinds of reasons people will buy it way out of the money. It might be analysts that just believe that the stock is going to go up to that price. There might be some great information behind why a firm or an individual is buying way outside of where the stock is at that particular time. So to answer your question, you don't have to go way. You don't have to pick a strike you think that it's going to go to. All right, you can buy it at the money at 307 and hold it for 3 months. And if this goes to $400 a share, you still profit. You're going to profit $93 over 300. You're going to profit $9,300. So don't pick a strike you think it's going to go to, because the further you go out, the more likely it's not going to happen. That's why it's cheaper. That's why it's cheaper, because it's more likely not going to hit that strike by the expiration date. But it doesn't mean that you can't trade it that day. And that's what I capitalize on. And I'll show you how to do it. All right, so we're going to look at another video, and then I'm going to go to Thinkorswim. And then I'm going to try to do all of this before 7:30 so that we can take a break, and then I can show you guys technicals and strategy. All right. Any questions that you guys have, go ahead and ask them in the chat area. My helpers are going to bring me those sheets, and I'm going to try to answer some of your questions as fast as I can. I'm not going to be able to answer all of them, but I'm going to try to get you guys as much information as possible. But remember, when we looked at this, what were the 4 steps? You're now understanding it. Oh, now we got to analyze a stock. We have to pick an expiration. We got to pick a strike price, and now we got to calculate the break even. It now makes sense. Or maybe there's a better understanding. You're picking a stock. You're figuring out how long to rent those 100 shares. Is it 7 days, 14, 21, 28, 3 months, 2 years? The further you go out, the more expensive that rental is going to be. And then you got to figure out how much you can lose. If you're buying a call or a put, the premium, that's the maximum that you can lose. Okay? All right, so we're going to look at a live video on the TD Ameritrade platform. Then I'm going to pull up my TD Ameritrade platform and show you guys, a couple of options. Hopefully we can get that in before 7:30. So we're doing good on time.
Now connected to Joel's MacBook Pro.
Hello, traders. Traders, it's 9/28, November the 13th. We're doing a webinar later, and I wanted to show you guys a live options trade. So today, we're going to buy an options trade. This is the Thinkorswim platform. The market is going to open up in 2 minutes. So we're going to buy one options contract, and we're also going to buy 1 share of Apple. And I want to show you guys the difference in how they move. I'm going to take early, and then I'm going to show you where the profit may be or the losses may be later. But for now, let me show you the option chain. So when you pull up Apple, you put in the ticker symbol here, you're going to get an option chain that pops up. And right here it says option chain. All right, we're going to be buying naked calls. All right, that means we're going to be buying call options, meaning that we want the stock to go up in price. This is where you pick what type of option you want. There's so many to pick from, but today we're just going to concentrate on naked calls, singles. All right. Anytime you see this color change, this is at the money, meaning the stock price of Apple right now is around $262. So if you want to buy at the money, you want to buy an option here or here. You also, if you want to know about how much it will cost, you just take this decimal point over 2 times. So an option contract here will cost me $299. This one would be $184. This one would be $440. Now the market just opened. So this is live. All right, we have not put in an order yet. So we're going to buy this option here. And if you notice, if we want to buy this option, we want to buy 1 contract. So we're going to take this down to 1 contract of Apple. We're going to do a weekly option, meaning that it will expire at the end of the week. And we want this to go up in price at 164. So this is as you can see, it's going down. So I think I want to buy it now. So when I hit confirm and send, it's going to tell you that it's going to cost me $161 plus commissions to buy 1 contract of Apple. So it's only going to cost me $161. So we're going to go ahead and hit send and see if that order takes. In the meantime, we're going to also buy 1 share of Apple. So we're going to go ahead and get in immediately by buying a market order. This is the active trader screen. And I'm going to buy 1 share of Apple at $261.47. Our option just took. And we're going to buy 1 right now. So we're just going to get in right now. So now we own 1 share of Apple that we paid $261.57 for. And we also bought 1 options contract of Apple. We spent less money on the options contract, but we're going to see which one pays off in the long run. So when you pull up your orders, you go to your monitor tab. And as you can see, we're already up $16. I can sell right now and have made, $16 today. Isn't that kind of cool? We've been in the market for 2 minutes and we've already made our $10 an hour. Now the price is going down at this particular time, but we own 1 share of Apple and we also own 1 contract. So you see here 1 and 1, that's 1 share of Apple. And we own 1 contract at $1.61. All right. Anything that's higher than 161, we profit. Anything higher than 261.57, we profit. Right now, look at what the option is doing. The option is already up $11. The share price is only up 20 cents. You see this? Options up $11. Share price is only 28 cents for now. We spent more money buying the Apple contract than we did, the Apple share price than we did the contract. Contract right now is up $18, $21. Apple's share price is only up 50 cents. So you see how in like 3 minutes time, just by buying an option, we have more leverage, meaning if it goes our way, we'll make way more money. And that's why most people buy options instead of buying the stock. We use less money and made more money in a shorter amount of time. I'm going to go ahead and get out of these particular, I'm going to go ahead and get out, and I'm going to show you guys how to do that as well. So if I want to create a closing order, I want to sell my 1 weekly at 180. Go ahead and hit confirm and send. And we're going to also get out of this Apple contract. Apple share price, I'm sorry. I'll go ahead and do market for that one. And if you really want to get out immediately, you just hit market. It's like this is not taking. Oh, and there we go. And look at there. In 4 minutes time, we made $19, and we were using roughly about $400 to make that $20. But that $181 that we used to buy that contract, look, we made $19 in 4 minutes. And that, you guys, is buying options contracts and an Apple share. And this is
all right. Cool. So what we're going to do is we're going to take a 5-minute break. It's 7:25 right now. All right. I want everybody to go grab a drink, grab some food. I want you to come back by 7:30. All right, I'm gonna give you 5 minutes. Any questions that you guys have, send it through the chat. I also, at the end of the hour and a half, because we're at the halfway point, I want you guys to I don't want everybody to do it, but I want you guys to give me one stock for me to analyze, and that's what I do at the end for all of my members. I analyze any and everybody's stock using all the tools that we're using, and we're gonna look at it as far as a strategy on how I would look at the market. So I only allow one though. You get one stock. So go ahead. Any questions you guys, go ahead and write them. All the stocks that you want me to analyze, go ahead and write those as well. Just make sure that stock is $1 billion in market cap or higher. All right. See you in 5 minutes. All right. So we had a couple of questions that came in. That's pretty cool. We only had about 3 or 4 questions. One of the questions that came in was, how would you compare TD Ameritrade to E-Trade? E-Trade, I guess. TD Ameritrade is the best. Look, I'm going to always say that. TD Ameritrade is by far the best. That's what they have a relationship with CNBC. So if you're ever watching CNBC, all you see are TD Ameritrade commercials. And if you have the platform, I don't know if you guys know this or not, but on the platform, you can watch TD Ameritrade for free through the platform. All right. So I still think everybody should have it. When you learn about the tools today, you're going to say, oh man, I wish I was on this particular platform for a long time, especially when we use the John Carter. Now, another question that came in, what about waiting for the strike price? Do you have to wait, or can you get out whenever? If so, what is the purpose of the strike price? Also, how did you know you would make money? All right. Well, you never know if you're going to make money. Now, I think I answered a lot of those questions before. You don't have to wait for the strike price. Remember, I told y'all that. You can buy a way out of the money strike. It could be $100 higher. If that premium goes up in value, you can sell that premium for a profit. You do not have to wait to the strike price. But if you wait until the last date, then that strike price plus the premium, that stock, the underlying, the price better be higher than that way out of the money strike you pick, or you're going to put your premium at risk to get took. All right. So the purpose of the strike price is basically like your bet. Am I going to bet on it going higher, or am I going to be safe and get a lower strike price? Every single strike price puts your premium at risk depending on where the stop price is by the last date. But you have up until that date to get in or out. You can take a loss for 10, 20, 30, 99%. All right. I see people do it all the time. They know that they're going to lose, and they say, man, let me just sell this loss and let me just get whatever amount of money that I can. And then as far as your break evens on TD Ameritrade, I'll show you guys in a second. So good questions. Not that many, but hopefully I was able to answer. So on the TD Ameritrade platform. Now, if this looks foreign to you, I do have a chart setup. Now, what I'm thinking about doing this weekend is I think I'm going to record a chart setup for you guys so that you can download it, and then you can make your charts look like mine instead of waiting to meet me one-on-one. But if you do meet me one-on-one, you can go to my What Would Joel Do page. That's the What Would Joel Do page on Facebook. You can also go through whatwouldjoeldo.com, and you can go to my services tab. I do one-on-one sessions. One of my one-on-one sessions is setting people's charts up. It takes an hour. It's $65. It's been $65 for 2 years. All right, I haven't changed the price. I don't think I will. All right, no matter how much money I make. All right, I'll keep it at $65. But what I do is I make your charts look like mine. I put all of my indicators, all of my strategies on your platform. We're gonna share your screen. You're gonna do it. But I'm going to make it look like mine, your watch list, your strategies, all that. Okay. So let's say that we were looking at forward. When you pull up the TD Ameritrade platform, all right, you're going to have the monitor tab, the trade tab. On the trade tab, you're going to have all products. All products is where you find your options. So you click here, and it's going to give you the expiration dates for forward. Well, as you can see, forward has the expiration date for the 18th. Now, why did I pick forward? I picked forward today because Ford came out with some news, and I've been telling people for about the last month that I've been buying Ford and General Motors hands over fist. I've hated Ford and General Motors for 10 years. I just finally started liking them because I've been doing my research. I found out, and the news came out today, and I'm so excited that Ford is now about to have an electric truck, and it's the Ford F-150 electric. They're about to build a whole plant just to build these vehicles. Now, if you know anything about Ford, Ford F-150 is the best-selling truck in history. Now that they're going to make it electric, oh my God. All right, I've been buying call options way out. Now, we talked about options that were unusual. I'm going to show you guys something unusual. Now, listen, I took this trade. All right, full transparency. I took this trade. Please don't take this trade, and then if you lose money, you blame it on me. All right, but I took a trade out to January, and I want to show you guys something. I want to show you guys what unusual looks like. This is an option that's expiring in January 2021. Look at how much open interest. 400,000 contracts have open interest at this strike price, which is $10, which is 50% higher than where we're at right now. Y'all see this? And there's nothing. I mean, I don't really see that much on the put side. I see a whole bunch on the call side. I don't see that much on the put, probably because of this event. Okay, so I matched that trade. I actually own this particular strike, and I also own this strike. This is what I call unusual, what do I call it? Legal insider trading. All right, and you can do that. You can go as far out as you want to. People think that you have to go out 1 week. Nah, these options only cost $10. Y'all can afford $10. If Ford goes up $3 in value, you're gonna make $300, and you only spent $10. I'll take that option all day long. All right. The other question was, how do you know how much you're going to make? I just told you. Every dollar move, you should make $100 in theory if you're going to wait until the expiration date. Now, day to day is going to be different. You got to check out the delta for that. You got to go to your layout. You got to go to volume, open interest, and you got to go to delta. And it looks like this. So if forward goes up $1 on that particular day, you're going to make, $40 per dollar move. That's huge. If you only spent $40, and if it goes up $1, you're going to make 100% return. Look at that. You spent $46 in every dollar move. You're going to make $40. That is huge. Now, for forward to go up $1 in one day, it can happen. You see that it went up 26 cents today. That means a dollar move is only like a 12% gain. A 12% gain in forward can yield you a 100% return. Kinda. You see what I'm saying? Not exactly, but about that much. So let's say you wanted to buy forward today. Let's say you wanted to have an expiration by the end of the week. Well, I want to go and see how much those options are. All right, so here's the options chain. Here's the spread. This is the spread that's going to tell you the different options you can buy. We're just going to buy singles. We're not going to talk about verticals yet. Okay? And then your layout is going to tell you which things you want to look at. So normally, y'all's layout is going to look like this. It's going to have your bid and your ask. I add the volume just so you know which contracts people were buying. Well, what were people buying today? They were buying this strike. You see how much volume is here and here? That's the strike price that I want to pick, 7 or 7.5. 7 or 7.5. Okay. Early this morning, it was lower than that. You could have picked this strike or this strike, and you would have made a killing. Okay. Look at how much the options cost. You can't afford $31 or $3. $3 controls $700 worth of forward. $3 controls $700 worth. Okay. Why? Because every contract controls 100 shares. So let's say I bought this option. Okay. One contract for $31. How do we read it? Okay. Let's see how it reads. Someone asked, how do you calculate the break even? Your break even is always going to be the strike plus the premium, the strike plus the premium, the strike plus, guess what? The premium. You always buy on the ask. The strike plus the premium is going to give me my worst case scenario. So look, I don't even have to look here. And I know that 7 plus 31 is $7.31. We're at 7.28. So this particular strike is telling me that if forward is not higher than $7.31 by September 18th, the maximum I'm going to lose is $31. Let's see if it says it. Sure enough, that does say 10. So let me change that. And this is everybody's platform does this. The default setting is 10 contracts. So you got to make sure you make that one. Okay. Limit order means that price or better. You don't have to buy it for 31. Let's say you wanted to buy it for $29. You only had $30 in your account. So you said, I can't buy it for 31. Let me buy it for 29. You can change this. You can put a limit order. Limit order means this price or better. But let's just go ahead and do 30. All right. To keep it simple. This is telling me that I want to buy one contract of forward that controls 100 shares. All right. That means I'm going to control $728 worth of forward for $30. Okay. $30 is the maximum amount I can lose. That's it. Okay. Plus dividend risk, if you hold it. But I mean, you're not going to have anything at risk, in the next 3 or 4 days. Okay. It's going to cost me 65 cents in commissions. That's the maximum amount I can lose. Well, what's the break even? It's going to be 7 plus 30. 7 plus 30 is 730. So if forward is not higher than 730 by September 18th, I can lose $30. Well, Joe, what happens if it goes to $8.30? Well, you're going to make $1.30, $130, and you're going to be able to keep your premium. You mean to tell me, Joel, I could spend $30 and make $130 if this goes up, $1? Yes. Well, why isn't everybody doing this? I don't know. It's the ultimate trading tool. Okay. Don't worry about these numbers. These are my numbers. All right. How much money I can afford after I buy my particular option. Okay. All right. So that's how you place your order, a limit order. A limit order is that price or better. Now, I don't want to get too confusing because some people are like, can you put a trailing stop? No. From what I know, you got to watch the option if you're trading. Now, you can put a stop loss in place or you can put a target. A stop loss means if I'm in a trade. So let's look at some of the options that I have. All right. Don't laugh at my options. Okay. All right. There's a couple of options I'm in. All right. And they're not doing too well, even though Beyond Meat made a lot of money today. All right. Let's say I wanted to get out of my forward option that I have 10 contracts on. All right. You do a create closing order. So if I'm in forward, this forward option, I own 10 contracts. Forward January, it says here that my January 2021 call, I have 10 contracts. I have 120 days left for that option to pan out for me. I spent $9.50. I spent $21. So I'm down 50%. I'm actually about to buy more. I was waiting for this to happen. I'm buying more tomorrow. All right. Because I'm going to load up. But I committed by buying some and I got all the way until January. But let's say I wanted to sell that order right now. Well, I would go to create closing order. I would sell those forward contracts. I'm going to sell 10 contracts of forward and I can put it for whatever price I want. I can do it higher. Right now, the price is $9. I can say, you know what? When it gets to $39, I want you to sell it. You put it here. It's going to tell you $390 is how much you will make. Or you can say, you know what? If it goes lower than right now, it's at $9. Let's say, look, if it goes to $10, I just want to walk away with something. Well, you can do a stop loss. All right. A stop loss just means get me out at market price if it drops to 10 cents. And now you don't even have to be at your platform. You can be on the beach. And if the forward option drops to 1 penny, which is $10, it will sell it. And you will get out with $10. And usually stop losses are for a loss, in value. Okay. All right. So So I want you guys to watch this, all right? There's a lot of questions. You're going to have access to this video. Lots of information I still got to give you guys. So let's get back to our presentation. All right, 5-minute break is over. Now, what I want you guys to do now is I want you to empty your mind. I want you to be formless, shapeless like water. We're going to think like Bruce Lee. Any and everything you learned about the market or options, I want to put the good habits in. I want to put in new information so that you can approach the market correctly. We're going to start, instead of looking at the market in one way, we're going to look at the market in 3 ways. We're going to look at the market using 3 charts: a 1-minute chart, a 1-hour chart, a 1-day chart. That's it. If you've been struggling as a trader, I want you to try this. All right. Anything longer, if you know that you're going to buy something, you know you're going to be in it longer than 30 days, your options, you should be looking at a day chart. You should be looking at stocks that are trending up. All right. We're going to talk about some of the easiest strategies. If you're looking to buy something within the next 30 days, 1 to 30 days, I want you to use an hour chart. I don't want you to look at a day chart and an hour chart and a minute chart every single day. You need to know what chart you're looking at for the time frame that you want to be in that option. We're going to split yourselves into 3s now. Your business has 3 departments. You have a short-term department, medium-term department, and long-term. And options, long-term is anything longer than 30 days. Medium is going to be 1 to 30 days. Short-term is going to be 1 minute. And we're going to look at the market in that way. We also want to look at the market like this. The trend is your friend. The market stair steps up in value. That means it's 80% of the time is trending up or trending down. The market does not trend sideways. Stocks 80% of the time are going up or down. So if you have a strategy where you're trying to buy every time it comes back to the price that it started at, you don't have a trending strategy. You have a sideways move strategy, which is probably why you've been struggling in the market. Well, the market stair steps up. When a stock trends to the upside, they don't come back to the price that they started at. They stair step up and then they stair step down. So the trend is your friend. All right, so we're going to look at some advanced technicals. Switch our brain. We now understand how to buy options. Now we got to know what tools to use so that we can apply strategy to these 3 different ways that we want to look at the market: short, medium, and long. I'm going to start off with the easiest strategy on the planet where everybody should be trading and investing in the first place. Now, it's going to make you mad because it's not sexy. It's 30 days or more, okay? Now, just so I make sure that everybody's awake, I want you guys to answer these questions for me, all right? Let me clear the responses. All right, wake up, wake up, wake up. Answer these questions. You paid a lot of money to learn. We're going to learn today. What indicators do you use most often to trade? All right, moving averages. So a lot of you guys are already using strategies. See, a lot of people are using John Carter and still struggling, which is surprising to me. If you're struggling and you're using the John Carter, I can fix your whole strategy within 5 seconds because it's probably risk to reward or looking at the wrong chart. It's always one of those 3 things. You're either using the wrong chart for the time frame you want to be in it. Your risk to reward is off. Okay, it's going to be one of those 2 things. All right. Cool. It looks like moving averages. So a lot of you already know about moving averages. If you don't use moving averages to trade, I don't know who taught you how to trade. All right, because you learned about moving averages day 1. So first things first, we're going to learn about support and resistance. All right, support and resistance lines are just areas that the market like to go to. The only way you're going to be able to see support and resistance lines is through charts. You got to learn how to read a chart. Support areas are just areas that the stock can fall to, and traders love using these areas to take trades. Resistance areas are areas that stocks have a hard time getting through. Usually whole numbers are very hard to get through. The $100 mark, the $1,000 mark, the 10, well, the 500. These whole numbers. I know a lot of people that trade around those whole numbers. So how does support and resistance look? It looks like this. So when you look at a stock chart, remember, even if a stock chart is trending to the upside, it might go sideways for a little bit until they get a catalyst. Let's say you were buying eggs right before COVID. Let's say you were buying eggs before March, and the price of eggs will go to $1, and then it will go to 2, and then $1, then 2. Well, you knew that the support area to buy eggs was $1, but every time it got to $2, you held off. You said, I'm not going to buy eggs for $2. I know I just bought some last week for $1, and then as soon as it gets to $1, you buy it up again. Well, when a catalyst comes, which causes a stock or an item to go up in value, the price that it had a hard time going through, which is what we call resistance, ends up becoming support. So even though $2 was hard to break through, once you broke through $2 and it went to $4, now $4 is the resistance and $2 becomes support. Same thing happens in the stock market, and it looks like this. Traders love using these areas of taking trades, or areas where they see that the market's going to pause, and if it starts to go up in value, they take a trade. That's how I trade. I trade on waves. We're going to learn about waves in a little bit. So again, the trend is your friend. I'm going to say this about 5 to 10 times because most traders, I don't understand why they don't understand this. But when stocks go up, they're going to continue to go up. I know traders right now that's like, I'm not going to buy that stock because it just keeps going up. Well, isn't that why you're trading? Aren't you trading to make money on something going up? And they literally are waiting for it to drop. And then when it drops and they buy it at the same price it started at, they worry why it's going to go lower. Because stocks that go up in price tend to stay in that direction. You got to learn how to bandwagon. If you don't know how to bandwagon and get into particular companies and you're just a negative Nancy on the market, you're going to have a really hard time being a momentum trader. All right. I've seen a lot of bears out there. They don't last that long. All right. Because they get wiped out because the market is rigged to go up. A lot of these stocks that we're looking at every day, they're going up no matter what you think about the market, no matter how you feel about it. They go up because they're rigged to go up. Money is being printed. When you hear the government saying that they're printing money, that money is finding its way into the market. And I don't care that there's 20, I care, but the market does not care about 20 to 50 million people being out of jobs. We're sitting at all-time highs. Does the market care? No. The market's going to keep going up. Nobody cared that Tesla didn't turn a profit until last year. It's now the largest car company on this planet. All right. My wife picked up a Tesla today, to be honest. All right. And no matter how many Teslas, no matter how much you feel about Ford and General Motors and seeing how many cars you see on the road, if the trend is up, you got to stay with the trend. You can't go with common sense in the stock market. It doesn't work. All right. The common sense is to see money flowing into something and it's going up. You see money flowing out of something, it's coming down. So we use trend lines to figure that out. I know so many people that just buy something because they think it's going lower. Well, the news was bad, so I'm just going to keep buying it as it goes lower. That is the most terrible way of trading. We use trend lines to give us an idea of when a trend is over. So when things are going down in value, what I want you to start doing now is I want you to add a trend line. The way a trend line works is when you see stock price starts to go down, I want you to put a trend line over the head or the tops of all the candles as if it was the water line. See, when things go down, they're underwater. I can't breathe. As soon as those stocks take a breath above this water line, maybe the trend ends and it can continue in another direction. It's the opposite for stocks that are going up. When a stock is going up, it's above the water. But as soon as it breaks underneath the water and it can't swim, blah, 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 can't swim, then you might see a trend going down. Use trend lines to give you an idea of when to get in and out of a stock. Because trying to catch a falling knife, see, somebody thought Apple was cheap here, 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 and here. Y'all know I just waited. I just laughed and laughed and laughed. And then as soon as Apple took a breath, I got in. Finally, somebody caught it here. But it was the same person that tried to catch it here, 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 and here. They finally caught the low. But when you average all of that out, it was at the same price I got in the first place. Just wait. And during that time, you could be making money on something else or not losing money. And then when things are going up in price, well, Joe, when do I get out? Well, are you looking at charts? No. Well, then that's why you're having a hard time trading, because you're going off the news. News is the worst way to trade. News is great for trades or investments longer than a year or two. It's terrible for a week or two, because when we get the news, it's late. You're literally just trading off of the frenzy of the market. Okay, so use the technicals so that you can finally see the real, what's really happening. If it breaks below here and I'm underwater, then the trend might be able to go down. So we want to use trend lines. I want you guys to use the Fibonacci tool. The Fibonacci tool is the first tool that traders should use to give themselves a chance of buying something when things are trending up. And I'm going to say this quickly. You're going to have to just pull up the video because I want to make sure I get all the information I can in today, because we're at hour number 2. We only got one more hour. And I still got to talk about strategy. Well, when stocks go up like Apple, they trend up. The largest companies on the planet are going to always be the easiest to predict their movements. I keep telling people that over and over again. If you're struggling as a trader, quit trading the penny stocks. If you're struggling as a trader, quit trading the stocks nobody knows about. Because the smaller a company is, the less predictable it is. Yeah, the more money you can make, of course, because baby companies grow, and that's where you make money in the market. But if you're trying to trade, I didn't say invest, I said trade. If you're trying to trade, you want to trade the larger companies and then invest in the smaller companies, not trade the smaller ones. They're hard to predict. Apple is the largest company in the world, therefore it's the easiest one to predict. If you can't make money technically off Apple, trading might not be for you. And I'm honest when I say that, because look at what Apple did over the last year. Okay, this is a year chart. Y'all remember the March lows? How come everybody knew to buy it here? Because by using this Fibonacci tool, we've learned that when stocks tend to go up, they're going to pull back about half of their move before they go higher. So half of this move, if I had to take an average of half of this move, 140 to 220, half of 140 to 220 is 80, half of 80 is 40. 40 minus 220 is 180. Look at where everybody bought it at. Then it moved from 170 to 220. 170 minus 220 is 50, half of 50 is 25, 25 minus 220 is 195. Look at where everybody bought it at. Then Apple ran from 190 to 330. Well, what's half of 190 to 330? Well, the whole move was 140. Half of that move was 70. 70 minus 330 was 260. Where do you think everybody started to buy Apple? At 260. And then when Apple moved from this point to this point, just by using this tool, it told us the halfway point, which was right here, which is where everybody bought Apple. You think all of a sudden they just started selling a bunch of iPhones on this day? No, traders have been using these tools for years, and now you have access to it. All right, so let's talk about some advanced strategies. Those are the tools that we're going to use. Trend lines, support, Fibonacci. I keep it so simple. And these are the tools that I use every day. And I can out-trade anybody that's out there because I've learned price action. The stocks are either going to go up or down. Options are either going to go up or down. All right? Y'all make it so difficult. You got 27 different ways. You're studying something for months on months on months. It's either going to go up or down. Use the charts to figure out the edge that you need to know if that stock is, or that option is going to go up or down in price. So the easiest indicators to use to recognize a trend is going to be the 200-day and the John Carter. I don't need the 50-day. If you're struggling as a trader, quit looking at the 50-day, quit looking at the 100-day. You got to start from the basics of the basics if you're struggling and you're not making money. The 200-day moving average. That's it. We're going to start there. And we want to use the John Carter. Now, the John Carter is the best trending indicator on earth, in my opinion. Why? Because it's going to tell me, it's going to give me a 75% chance that a stock is going to trend in a certain direction. Now, I already told you stocks already trend 80% of the time, either up or down. Now I got an indicator that's going to give me a 75% chance that it's going to go in that direction. Shoot, that's what I need. Most people don't know about the John Carter. Okay, so how does the John Carter work? You want to look for 3 consecutive green or red candles. I'm going to say that again: 3 consecutive green or red, 3 consecutive green or red, 3 consecutive red. 1, 2, 3. This is the March lows. I mean the February. Y'all see that? This is February. We all knew to get out of Apple right there. 1, 2, 3. Guess what direction is going? Down. When was the next time we saw 3 green candles? 1. Okay, 1, 1. 1, 1, 2, nope, 1, 2, 3. Bam, right there. Y'all know we never came back to that stop price? We ain't never come back. That's where I got in at. Okay? Easy. It was an easy trade for me. Tough for you. Why? Because you've probably been trading blind and you're trading off news you see on TV. Stop using the news. It's going to throw you off. News is great. I love the fact that, because see, while I was already in this, I heard about the stock split. Great, I can make even more money. And if it goes down in value, who cares? Look at how much profit I made. So you're looking for 3 candles for the trigger. 1, 2, 3, 75% chance is going that way. 1, 2, 3, 75% chance is going that way. Well, Joe, which charts do they work on? Every chart. I don't care what chart you're looking at. But you got to know how long you want to be in it. This is where you guys make the mistakes. 1, 2, 3 green. I'm going to take an expiration at the end of the week. That's where you just went wrong. When using this strategy, you need to be going 30 days or more out, period. If you didn't take an expiration 30 days out, chances are you might have lost. Because look at what happened. Using a day chart, you would have taken, let's say, a 10-day trade. 1, 2, 3, 4, 5, 6, 7, 8, 9. Look at what price we came back to, the same price you got in it. That's why you guys lose in the market. You don't give yourself enough time for the trade to work out. If you gave yourself 30 days, you would have made so much money. But the problem is you try to be cheap. You try to buy you want to buy Apple so bad, so you look for the cheapest option, which is going to expire at the end of the week, and then you gamble on it. And then when you lose, you're like, where did I go wrong? Well, first of all, you were looking at a day chart trying to trade for the next 3 days. You don't do that. If you want to trade in the next 2 or 3 days, you want to look at an hour chart. And then when you pull up the hour chart, you probably would have noticed that it was not going in the direction you wanted to. Okay? You got to know what charts to look at. So I'm going to show you guys the easiest investing strategy. Easiest investing strategy on this planet. I don't care who you put me up against. They're not going to give you a better investing strategy than you're going to learn today. You're going to be able to use this for the rest of your life. When you're 90 years old, you're going to be like, man, I remember when this crazy dude named Joel claimed he had the easiest strategy, and it actually was. Everybody else uses 17 different strategies. This cat is still using 2. I always tell people, if you're using more than 2 strategies or indicators, you probably lose. The more indicators I see on your chart, the more you're losing. I already know it. When my clients pull up their charts and I see 17, I'm like, okay, that's why they're losing money. They got indicators canceling out the others. How the heck are 17 different indicators going to say the same thing at the same time? The problem is you're trying to find things that's giving you You're trying to find indicators that's going to go against what you believe is going to happen. And the more indicators you pick, the more likely you're not going to take the trade. And then you miss it. Everybody's been a victim of that. All you need is 2 indicators, period. Anything more than 2, you're going to confuse yourself, in my opinion. Okay? It's just like if you put 10 people in a room and ask for an opinion. There's no way in heck, or a jury. There's no way in heck everybody's going to believe the same thing or have the same story or see the things the same way. The less you have, the better it is to make a sound decision. So the easiest investing strategy on this planet is trading 30 days or more. Period. It's the easiest. Will y'all do this after this webinar? Probably not. Y'all keep me in business. The traders that don't know what's easy, you keep me in business. I will be a consultant forever because the easiest money to be made, only 10% of traders or investors are doing it. Only 10%. Only 10% are trading 30 days or more. And those are the ones that are profiting. Now, I'm not telling you not to do it. It's just that most traders are not going to buy options 30 days or more. They're going to max out their account, buy one option on that stock that they want to buy. They put all their eggs in one basket, and if it doesn't work out, that's it. That's why you're losing money. I already know it. I've been there, done it. I've been you. Remember, I'm in the trenches with you. So we want to do all 3 at the same time. You want to have 3 different accounts. You want to have a long-term options account, a day trading account, and medium if you can. If not, you need to at least have 2. Every single person on this call should have 30-day or more trades for options, and then maybe one that's less than 30. You got to if you want to win in this game. The longer you wait, the better off you're going to give yourself a chance to win. So the easiest trade on the planet is using the 200-day moving average. The 200-day moving average is this line here. It's literally the average price of this stock over the last 200 days. How did everybody know to buy Apple during the March lows? Do you think it was by chance that we were sitting on the 200-day moving average? No. Because anytime Apple or any stock that's in the top 30, I want you guys to do something. I want you guys to take the top 30 companies on this planet, and I want you guys to do this for me. I want you to go back and look at each one and see how they responded to this 200-day moving average. You're going to see the same thing. If you have an upwards trending 200-day and you see a stock drop to it, you're going to draw a trend line here. When it breaks that trend line and you see this go green, 1, 2, 3, even if it's underneath it, as long as this is angled up, you're going to have about a 95% chance of winning 30 days or more. Easiest trade on this planet. Some of you guys are going to get this, some of you guys aren't. That's why 10% of the world owns 90% of it. Okay? You got to get out of those bad habits. If you're not winning, you might need to try something new. You got to be patient. So I'm going to teach you guys the easiest first. So the 200-day moving average, I'm not going to look at all 30 stocks. I just pulled all 30 for you guys. Snapshot this if you can. If you know that you're not going to watch this Friday or Saturday, you better do a snapshot real quick. All right? Because we're going to look at Apple, Microsoft, Amazon, Alphabet, Google, and Facebook. I'm only going to do 5 really quickly. And I'm going to show you how they react towards the 200-day. Okay? Now, this is Apple first, so we don't even have to look at the other. We only have to look at 4. So by looking at Apple, watch what happened. In March, Apple went down in price. Look at this. 1, 2, 3 red. That means it was going down. When it went down, everybody knew where it was going to, but I don't want you to just buy an option the minute you hit the 200-day. The 200-day was angled up. Anytime it's angled up, it's a bullish stock because stock price is above the average price over the last 200 days. Hedge funds and pension funds and mutual funds love stocks like this. They love it. They love it. They buy it up. You don't believe me? Look at the top 30 companies. It's the same move. 200-day, it breaks its trend. It goes green, 1, 2, 3. You buy it. You make money 30 days or longer. That's the key. 30 days or longer, not 7. You only hit the 200 and I bought an expiration date 2 days later and I lost all my money. You are a fraud. Okay, 30 days or longer. 30 days or longer, right? And remember, guys, charts don't lie. I don't want y'all to believe me. Do your due diligence. Learn how to read a chart. And then in the back of your head, you're going to hear Joel say, I told you so. I told you so. I told you so. That's what I want you to hear. That's what I want you to go to sleep listening to. All right. So trend line down. How long do you stay in it? Did we break this trend? We broke it there for a second. A lot of people sold right around in this area, but then we got above it. And look at this. 1, 2, 3. John Carter went up. We're still above this line. Now people are starting to sell it. Well, Joel, when do you get out of the trade? I don't know. That's up to you. All right. I don't tell people when to get out. That's up to you. I don't know what your goals and your dreams are. I'll tell you when to get out. But we'll talk about that later. All right. So when I'm buying a 30-day or longer trade, what am I going to do? I'm going to buy it 30 days out. And I'm going to use a day chart. So anytime I'm looking at the 200-day moving average, I'm looking at a day chart, period. I don't use the 200-day on an hour chart or a 1-minute chart. I usually have this thing called the Ichimoku on it. So I want to use a day chart when I want to go 30 days out when I'm using the 200-day moving average. You got to have all 3. You got to go greater than 30 days. That's the problem. Some of y'all pay me $65 and you ask that question the very first time we sit down. And I feel so bad because you could have just shot me an email and I could have answered that question for you. Why am I losing on this? I'm looking at this 1-minute chart. There it is. You just answered your question. Why are you looking at a minute chart for a trade that's going to happen a year from now? I don't know. That's what I learned on this YouTube video. Did you vet the person you was listening to? All right. Are they actually trading? All right. All right. Everybody knows I trade in the inside trading room. I'm calling trades all day long. I'm using real money. I usually go out of the money. When I'm going long term, I usually go out of the money. Why? Because the longer that I rent my shares, my options contract, the more expensive they're going to be. $500. All right. If I go out another week, this $500 contract at this strike might be $1,000. All right. So I have to go out of the money so that I can keep it cheap. And then I'm going to go for the one with the most volume. Y'all see this? Why would I buy this one? Why would I buy this strike when this strike $3 higher has 50,000? 8 times what these people bought? Because these people know something. Now, this isn't foolproof. This might just be a dummy out there that just got a bunch of money that's hedging themselves. Okay? And they don't have to be a dummy. All right? But there are a lot of people out there with money that just got money to throw at stuff. Hey, I'm going to throw $50,000 at, this particular option because I'm making $50,000 a day. There are people out there like that. But I'm still going to pick it because it's more likely going to happen, especially when you see a bunch of other strikes that also have a lot of volume. Then you go over here and you don't see nothing. The biggest volume I see over here is 29. But I see 42, 51, 57. It's probably going to go higher. And guess what happened, guys? Apple went higher. This is old. This is old news. Apple went higher. Every single one of these strikes were hitting. Okay? So when do you exit the trade? So when do I sell? I don't know. But at least, did you reach your target? What's the target? Well, how much were you planning to make? I don't know. Well, then you're gambling. Did the support trend line break? What's a trend line? You don't know what a trend line is? No. Well, then you're gambling. Did the John Carter go 3 candles the same color? No, you don't have to know about the John Carter. But if you're trading and you don't know what a trend line is or your target, you've been gambling. You've been in a casino. Did you hit your maximum loss? What you mean maximum loss? I don't lose. Oh my God. Y'all keep me in business. This game is not about winning 100% of the time. I win 3 out of 4 times. 65 to 75% is where the elite traders are winning. Okay, you're not going to win 100% of the time. When you lose, are you losing a little bit? When you lose, does it blow up your account? If it is, I just answered your question within the first 3 minutes of our consultation. If that's the way you're trading, your risk to reward is not as incorrect. You're risking too much money and taking a little bit of money in profit. I see y'all do that all the time. You're risking $5,000 and then you're going to make $100. You can make $100 every day for 4 weeks. That's $2,000. And then the 5th week, one day, you got one bad day and lose the whole thing. And then you're calling me up, Joe, I don't want 99% of the time. And then I lost on this day. And I'm trying to figure out why I lost. I don't understand. Because you didn't expect to lose. If you're trading that way, it's just a matter of time before the house wins. You can't pick black all day long and not expect red to hit. A lot of you guys trade that way. Stop doing it. Shorts are going to be the opposite. So to give you guys a head start, these are some of the companies that I'm invested in. All right. So if you're having a hard time even picking stock, well, here's a list for you. I gave you the 30 top stocks first. And then I want you to start compiling your own list. All right. And with that list of companies, I try to stick to these companies when I'm bullish. What kind of companies am I buying 30 days or longer out in options? Well, they better have e-commerce attached to their name because that's what's hot right now. Web services. You know, Amazon has web services, Google, Microsoft, and Apple. Does the company stream? Is there a subscription service? Are they an industry leader? Okay. Even the industry leaders. You might want to buy Beyond Meat, the industry leader in fake meat. You might want to buy Canopy Growth, the industry leader in cannabis, because the trickle down effect is a real thing in America. All right, the larger a company is, the more likely they're going to get money before somebody else. You think when the government decided to print money that the poor got money first? Heck no, the rich got paid first, and then the leftovers went to the poor. Same thing in the stock market. If you were managing a $20 billion account and the March lows happen, are you going to throw money at the airlines? No, I'm investing in Amazon, Apple, all the companies at the top, not the companies at the bottom. I want my firm to be around. These people are relying on me to make sound investments. I'm not going to put all my money in Nikola. That's how a lot of you guys are trading. Your firm is all over the place. You're not making sound decisions because you don't believe you can make money in sound companies. Because you've been talking to the wrong people. You think that the only way that you can make money is through some company nobody knows about, that you got in on before anybody learned about it. What? That's fun to do and fun to say. The money that I make the most of is on companies that everybody knows about. It's rare that I'll make money on some other company. Like I made money on Tesla, holding it, for the amount of time I've been in. But that's not where I made the most money from. Okay. So, you don't have to necessarily go after those nobody knows about companies. All right. So let's go look at some charts. All right. Let's apply some of the stuff that we're looking at. So let's look at the 200-day. All right. We already looked at, think about Ford. I just talked about Ford. What do you notice about Ford? Ford has a downward sloping 200. That means Ford has been a terrible stock to buy in the last 3 years. Look at this. This is from 2017 till now. A lot of you guys are buying it because it's $7 a share. It's been going down. And look at when it got up below the 200-day, hedge funds don't want to buy it. Look at this. It was going down before the pandemic. Now, the only reason why I'm hyped on Ford now is because we're getting above the 200-day. Maybe we can get this to turn around. And I have a very long time frame that I'm looking at buying Ford on. You know why? Because 30 days or longer is when you make the most money. So if I want to bet on something like this, I can't bet on something that's terrible in the next week or two. If I want to make money on a company in the next week or two, I'm going to buy a company that's bullish. All right. So if I was drawing a trend line, it would look like this. You always draw your trend lines across the top of things like this. This trend going up, I'm going to draw a trend line right there. Okay. If it breaks this trend line, we're probably going to fall to a support area. If we get above this trend line, I have a chance that it can actually go somewhere, but not until this downward trend ends. You don't even have to buy Ford now. But so many people are like, I want to be the one that gets it at the lowest price. You can wait. You can buy this stock at $10 and it can go to $15 and you still make a 50% return. Why you got to be the one to buy it at the lowest price? Wait until a trend breaks before you decide you want to buy it. Let's use the John Carter. Let's look at the John Carter. Let's just say you were using the John Carter because a lot of you guys still don't know how to use it. Well, once you started getting an uptrend, what do we notice? 1, 2, 3, 3 candles. 1, 2, 3. It started to go up in value. 1, 2, 3. Why do you have to give yourself time? Because even when this went 1, 2, 3, it stayed down for 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 days before it got back here. It didn't even go higher to another 30 days from there. You got to give yourself some time when you're looking at a day chart. Some of you guys are using day chart for 3-day trades. No, you should be looking at an hour chart. We're going to look at an hour chart in a second. Let's look at those top companies I was telling you about. So we look at Apple. Let's look at Amazon. What do you notice about Amazon? What do you notice? An upwards 200-day. What happened in March? What happened in March? 1, 2, 3, it went down. 1, 2, 3, it went down. What did it go down to, the 200-day? Joel said if I'm looking at a day chart and we hit the 200-day and I buy an option or stock, it has to be 30 days or longer, or I'm going to wait until this trend breaks and I see it go 1, 2, 3 green. Well, it went 1, 2, 3 green. How did I know to buy it? Because it was one of the 5 largest companies in the world. You don't become one of the 5 largest companies in the world if you don't get money. Y'all make trading so hard. How long did I have to wait before I started making money? 7 days. And it never came back. Never came back. Joel, how long should I be out of this? You should just now be getting out because this trend line held from June to September. I know y'all are selling way back here because of news. Well, I got a friend that works for Amazon and they said that the coronavirus is coming back strong. Well, I don't see it being reflected in the stock. So I don't care what your friend saw. It's still going up. Now it's finally breaking the trend. Okay. Maybe you want to trim some of that stock now. Okay. Because you see all of this red. That's Amazon. So we look at 2. Amazon, Apple. Let's look at Google. Let's look at the Googles. Same thing. What happens every time it hits the 200-day? It goes up. Every time it hits the 200-day and it's angled up, it goes up. What happened in March? Same thing. Why is Joel never panicking? Because I've seen this for 10 years. It's the same thing. The market is battle tested. Ain't nothing gonna bring the market. We had 3 chances to have 1929 type lows. And it ain't happened. 2000, it didn't happen. 2008, 2009, when it should have happened, didn't happen. Pandemic just happened, had the most job losses ever. Didn't happen. Because the rich got richer. Look, hit the 200-day. Do I get in yet? Nope. Breaks the trend. 1, 2, 3. Joel gets in. Never comes back. Joel, should I get out now? When do I get out? I don't know. Did it break that trend yet? You could have got out right around here. I think I sold some Google right here. I'm still in. but then it got above it, and then it broke it again, and now you got 3 red. Where are we going down to? I didn't even notice this. Look at how close Google is to the 200-day. I just made y'all some money. Look at this. Look at what Joel is about to buy, and I guarantee it. Watch what happens, guys. I get people all the time. We're going to hit the 200-day. We're going to go up. Joel's going to put out a recommendation in the room. At least 10 people are going to tell me I'm an idiot, and I'm just going to laugh all the way to the bank, just like I've done for the last 8 years. It's because it's the same pattern. Hit the 200-day. You see it sloping up for a reason. I'm showing you guys what the billionaires use to make money. Hit the 200-day. We're going to break this trend. It might go green on here, and then we're going to make money. Okay? That's Google. So we look at Google, Amazon. We got to look at Facebook and Microsoft. Microsoft, same thing. It's like a broken record. What happened when it hit? And it all happened in March. Hit the 200-day. 1, 2, 3. How can 5 companies exhibit the same exact pattern? Because I'm going to tell you how billionaires think. They don't do what we do or what y'all do. They don't take the whole $5 billion they got in their pension fund and throw it in one company. Nah, they're going to spread it out over 100 different companies. But the highest percentages is going to go with the ones that are at the top because they do the trickle-down effect. That's why every single company at the top is exhibiting the same thing because they're getting the same money. That fund is going to be invested in Amazon, Google, Facebook, and Microsoft. They're not going to own one and not the other. They're just not going to do it. So that's why you see them exhibiting the same exact thing, the same exact pattern. Okay? Easiest strategy on the planet. 1, 2, 3. There you go. Did we ever come back? Nope. Should you be getting out? Oh, when should I get out? Maybe now. Okay? Let's look at the last one. Facebook. Same thing. Down, up, green, up. Trend line, trend line. Y'all got to learn how to do this. If you can't do this, you shouldn't be trading. See how fast I did that? See how fast I did this? You got to get good with your trend lines. When it's going up, you want to put the trend line on the bottom, touching the wicks or the body. When it's going down, you want to put it across the top. See, you can't go higher unless you go through here. Everybody is going to come down to this 200-day. Why y'all think I got alerts right here? This is the genius of trading. This is how you predict stuff. You learn how the billionaires trade, and you trade like them. All right? And I'm showing you guys. 10% of you guys will get this. 1% of you guys will put it into play. These are real numbers. Do you want to be one of those 1%ers? Or do you want to just let it go through one ear and out the other? All right? See, this is trend lines. A support area would be the 200-day. The 200-day acts as support. Resistance would be maybe here, the all-time highs. You got to know what a stock went to. You got to know where it can go to. A lot of you guys, I'm like, all right, you're in Apple. How long do you want to hold it? Do you know what the all-time high is? No. Well, how are you trading? Okay? Learn the charts. All right, let's go back. That was long-term trading. All right? Keep it simple. Easiest trading strategy on the planet. You're going to use a day chart. You're going to use a 200-day. You're going to use the John Carter support, resistance, and trend lines. I didn't really show you Fibonacci that much, and that's fine. I usually do Fibonacci's, with the 101s, okay? Because there's different ways you can use that Fibonacci tool. So the 1 to 30-day trades are the hardest to manage. 1 to 30 days. Anybody that's trading 1 to 30 days, y'all realize that's the hardest way to trade? You can make the most money, definitely. It's the hardest because it requires technical skills, which is why y'all are losing money. It's the hardest. 30 days or longer is going to give you an easy, and options is going to make it easy for you. 1 year or longer holds in stock, you probably win in 90-something% of the time. 90-something%. 1 to 30 days is the hardest way to trade. And guess what? 90% of y'all do it. Only 10% of y'all are investing or doing it the correct way. Or at least a large portion of your portfolio is dedicated to 30 days or longer. You know why? Because I don't want to wait 30 days to make money. I want my money now. I saw you buy an IA, Joel. I want my money now. I get it. But remember, I'm doing it all. I'm doing 30 day, 1 day, and scalping. Not just one. I'm doing it all. And I'm trying to encourage you guys. It's the hardest way to trade. I'm keeping it all the way real with you. It's the hardest way to trade. And if you're not using technicals, you're just giving away money. You got to learn the technical side of the market. So first things first, let's figure out how we're going to do it. We're going to use the what would Joe do method of entry. Y'all hear me talk about it all the time in the room. The what would Joe do method of entry is just buying when things are stair-stepping up, stair-stepping up, stair-stepping up. The market stair-steps up and it stair-steps down. All of the charts we saw, you saw it go down. And then even when they started to go up, they stair-step. Stocks don't go up in a straight line. My method of entry is always the third move. Because the third move is always longer than the first. You're going to see a move. It's going to drop in price about 50%. You see this move? About half of that move right here. Then as it starts to go up in price, I'm going to buy it somewhere here. And if it reverses on me, I'm going to get out right here. So watch this. 1% of you guys are going to get this. When I'm trading 1 to 30 days, I have to be right, and I have to be right immediately. You know why? Because think about it. When you're waiting 30 days for a trade, a CEO can have a DUI, and it happens. Like I'm being funny, but it happens a lot. Let's say you're in a stock and you got 5 days or option, you got 5 days before it expires, or you might lose your money if the stock is not lower than that price. And then that CEO gets in trouble, and negative news comes out. Then that stock will drop in price. All right, which will drop the option in price. So any negative news, and it's just about any news, you got to be perfect to win when you're trading 1 to 30 days. You literally have to be perfect, no negative news whatsoever. And that's what you guys are trading off of. Perfect news. If you go further out, you can stomach some of the moves. You can stomach the CEO getting in trouble. And then he comes out and they say, oh, he wasn't the driver. We made a mistake, guys. And then the stock is up. But you didn't lost on the option by then because it was on a Wednesday and the option expired on a Friday. You can't withstand the movement of negative news. That's why 90 days, 30 days or longer are going to always make you way more money than 1 to 30. I even like you trading intraday better. Why? Because if you're intraday trading, meaning I'm getting in and out the same exact day, even if I get negative news, I can get out immediately. The worst news that ever happened is the stuff that happens after hours because now everybody got to sleep on that negative news all night long and wake up in a panic. So trading intraday and trading 30 days or longer is where I trade the most. I don't really trade 1 to 30 days. I don't. Because it's where you guys lose the most. It's hard. It's going to make you the most money. It's not even going to make you the most money. I see why you do it because you have to buy cheap options. But I'm going to teach you guys how to buy cheaper options with a vertical in a second. So I like getting in on the third waves. 1, 2, 3. All right. When I lose though, let's say I get in here and it turns around and it goes here. I'm out right here. So look at how much I lose. I only lose this amount. But look at how much I win when I win. I lose this amount. I win this amount. I lose this amount. I win this amount. You know what you guys do? You get in a trade. It goes down in price. You say, man, I ain't about to take a loss on this because A, you don't even know what your risk to reward is. I'm not going to sell this because then I got to tell my spouse that I'm a loser. I'm just going to hold it because my expiration is Friday. I got 2 more weeks. I'm just going to hold out on it. And then what ends up happening? It goes here, then it goes here, then it goes here. Then your option is worthless when you should have just taken the loss immediately. Risk to reward. You guys don't do it because, for one, if you don't even know what your stop loss is before you even take the trade, well, it's just a matter of time before you lose. And then you're going to keep me doing consultations. I don't want to do consultations. I want to sit back and trade just like y'all. But I'm going to always be in business because most people don't approach the market like a business. They approach the market like a casino. They don't expect to lose. I'm going to pick red all day long, and I dare it to be black. All right. It's going to happen. I've seen ridiculous runs where I've seen black hit 22 times in a row. It's going to get red. All right. So it's the hardest way to trade. But if you're going to do it, if you're going to do it, you should be looking at an hour chart. So if you're going to trade the worst trading out there, use an hour chart to give yourself an edge, not a day chart. The day chart is going to get you in too late. Use an hour chart to give yourself an edge. An hour chart for days for trades that are overnight to 30 days. Okay. And when I buy the options, I want to buy options at the money. Remember, when it's 1 to 30 days, I have to be right. I can't have anything go wrong or I'm going to lose on this option. So I got to keep it conservative. The at the money strike is the most conservative option you can make. Well, that's not true. This is the most conservative, but the best risk to reward is going to be at the money. So I want to buy an at the money strike, and I want to buy the one with the most volume. So remember, when I'm buying out, when I'm going long term, 30 days or longer, I'm not going to buy at the money. I'm going to buy out of the money. I'm going to go way out here, and I'm going to pick the one with the most volume. When I'm trading 1 to 30 days using an hour chart, I'm going to buy it at the money. At the money, the one with the most volume. So I would pick this one. And it has to have 1,000 contracts or more. So I don't trade options where I see 3 contracts. If I see 3 or 4 up here, I'm not buying. Because I don't know if you guys know this or not, the options market is the least liquid market that's out there. As much as you hear people trading it, it's not as liquid as the stock market. In the stock market, whatever price I see Apple is right now during 9:30 to 4 o'clock, I can get out anytime I want for a loss or a profit. You can't do that in the options world. If there's not enough volume behind an option or a strike, you will get caught in that option. And it happens to the best of us. How many times have you been up 200 or 300%? You go to hit the sell button and you can't get out and you're wondering, why can't I get out? Because there's not a lot of activity at your strike price. You got 40,000 contracts here. You only got 9 here. If you see 40,000 here and 1 here, you're the only person that bought the contract. All right. So your exits are the same. We already went over this. Now, your outreach is going to be the same thing as your outreach on your long term. Did you reach your target? Support trend line break. Did the John Carter go the opposite colors, or did you hit your maximum? Now we have a strategy session next week. You also have a strategy book that's going to explain a lot of your entries and your exits. I can't spend so much time on every single one of them. I encourage you to take the strategy session next week. It's $35. I promise you it's worth it because we're going to go over everything we went over now, but it's going to be in a little bit more detail. I'm also going to create another strategy book that's a lot better than the one that I gave you guys, and it's going to be more detailed. It's going to have stocks, options, futures in it as well. All right, but your exits are going to be determined by you. There is no, this is when you're supposed to get out. And it's funny to me that traders even have this is when you get out. No, you don't know. You get out of a trade when you make more than whatever you risk. That's literally how you should be trading. If I'm risking $200, I got to make $200 or more. Anything over $200, I don't care when you get out. But if you're not taking at least $200 and you're risking $200, you're going to keep me in business all day long. I can answer your question on why your trading is terrible within 2 seconds. Oh, it's just risk to reward. You're risking too much and you're not taking enough. So let's talk about the rock stars, the stock stars, the fast money. Everybody wants to do this. Everybody can't do this. All right. Now, I actually think this is easier. It's easier to make money when you're doing fast money than it is, trading for a day to 30 days. So I want to tell you, all right, so if you're the type of trader that has a 9 to 5, you don't have the hours to trade, you don't have all the time to really educate yourself on what the market is doing. There's no way on earth you should be trading 1 to 30 days. You should be trading 30 days or longer, no questions asked. And if you're buying stocks, 1 year or longer, you don't have the time. And there's nothing wrong with that. It doesn't mean you can't make money. It just means that you want to put it in you want to make money, where your percentages lie. You don't have the time. All right, well, you need to give yourself enough time for stocks to work out, especially when the market is rigged. If you're the type of trader that has a 9 to 5 and this feels like gambling and you can't just get away from this, all right, then you need to just learn how to get in and out and say to yourself, look, if I can't watch the trade, I got to sell it. Okay. But the traders, and I keep telling y'all, 90% of y'all are the ones that really can't watch it. I gotta take a trade and I gotta